Good morning, investors. Welcome to the February 11th webinar presented by Portfolio Builder. Folks, want to welcome you in. Thank you very much for taking the time to join us here today. My name is Dean Gallagher. I'm an investment consultant and partner here with the firm. Folks, what I do specifically is help the people that take our one-time free trial to understand what we do and why. Okay, so we can help them understand how to put their capital into a tank, take the safest ride possible, and so far year to date, just absolutely smash the performance of the S&P 500. Okay, so quick look at the performance here, guys. This is the Safe Alpha portfolio here. Okay, if you guys have been following us here for a while, you're going to see that this is the same account number each day. Okay, and sometimes we show off also the boot camp, and you're going to see that that's the same account number day after day. Okay, so just wanted to touch on that. And it's funny, I actually had a client that I spoke with this morning. He said, Dean, I was wondering, if you guys were BS. And he's like, I looked at 3 days of webinars and it was the same account number each day. I said, so that was really cool. So I just figured I'd point that out. Just something I learned from a client this morning, or a guy that just transitioned from a potential client to a client. Okay. But pretty cool, guys. So this is the overall P&L. Okay, over 11 weeks now, or 2.5 months. Okay, that's $272,147 in profit. Okay, now let's look at the year to date, so we can go compare it against the S&P 500's performance. Now, guys, this is a really good start to the year for the S&P 500 at 4.37%. Okay, but if we look at our Safe Alpha portfolio, it's crushing those returns. Okay, and our returns, at this point are just shy of 5x. Okay, and so we'll do the math on it, but you can see right here, and this is no BS, guys. This is Thinkorswim's paper trading platform. Right, I used to actually use my real account up here. I can't do that anymore. We started realizing there's a pretty serious security threat to doing that, so I am forced to use the model portfolios here. Okay, but you guys are going to see this account number day after day. Until you sign up. And then once you sign up, you're going to see me with the same account number every time we make a change. You're going to see me do that with this account. Okay, so pretty cool. And overall P&L, guys, is 200,000. So $200,981. Okay, or at the time it was 20.38%. Okay, and that's going to fluctuate and move around, obviously, because markets are dynamic. Okay, but let's just take a look from when we did this screencast here, guys, to see what that math is. So I'm just going to take my 20.38% here, and I love using math because it's empirical and you cannot argue it. Okay, and so let's take our 20.38%, simply divide it by 4.3% to see our outperformance factor here is 4.66 times the S&P 500, or 466% better. Okay. Now, are we technically trying to beat the performance of the S&P 500? No. Is it good, constructive visual for you to understand? Sure. Okay. And guys, just real quick, we'll take the 10,000 foot overview on this. And then Jason's going to explain why we're looking for all of these assets to give us phenomenal returns, okay, this year. And then some will be more shorter term, okay? But we're going to have positions like the TQQQ that we'll never sell our core position on. And for me personally, guys, I'm never going to sell any of my shares of TQQQ. Okay, you're gonna have to pry them from my cold dead hands, period, bar none. Okay, because I'm never gonna sell them, and that's what's gonna take my family into the kind of the into the over time, the 8 and 9 figure level, somewhere between that before I pass away. Am I there now? Nope. Is it going to take me a couple decades to get there? Sure. Okay, so if you have a decade, 2, 3, 4, you might be like Jeff and really healthy and in your 60s and probably have 3 decades for your positions to run. Okay, heck, guys, the billionaires are going to make sure that they go from being billionaires to trillionaires and 4 or 5xing their money over the next few years. Okay, over the next decade or so. Let's join them. Okay, let's 4 and 5x our retirements over that span of time. Okay, because they're going to do it with their money. Let's attach to them, own the same stocks that they have 99% of their wealth in, and do the same thing. It's pretty simple. And you guys will realize how much control that they have over the world, over our government, over every major government around the world. And we'll talk about that more in just a minute. Okay. So best performing ETF ever been created in the US markets right here. That is our core position. Okay, next we do have our exposure to Bitcoin, and it's beautiful because you can do this through your tax deferred account with GBTC. You can't own Bitcoin directly through your IRA or 401k. This is a beautiful proxy to get exposure to it right now. Okay, before it goes up to 100,000 or so this year. Okay, and before quantitative easing is done to the 250,000 level, it's going to be a fun ride up. Okay, and outside of that, guys, we're in the middle of a currency war globally. This is your best currency deflation hedge that exists on planet Earth today. Okay. So next, guys, we are looking at COPX. Okay. That is exposure to all of the best copper mining companies in the world. Okay. The Belt and Road Initiative, if you don't know about it yet, you should absolutely. Okay. It's going to be the largest infrastructure project on planet Earth ever created. It's a big push into green energy from the globalists. Okay. So you want to own this because they're going to need a ton of copper to build out that project. We're going to need a ton of copper to build out all the EV infrastructure that our Oval Office is pushing right now. Okay. So you're going to want to own these companies now. Okay. And really, for a while as well. Okay. Next, guys, we have the rare earth miners. Okay. This is a ETF we actually just picked up. Okay. So I actually, in my account, just picked it up here today in the Safe Alpha portfolio. Okay. So this is, folks, an aggregate of all of the best publicly traded rare earth mining companies. So all of these companies that pull all the lithium out of the ground, they pull the cobalt out of the ground, they pull the palladium, the platinum, all these things we need to support robotics, AI, economy 3.0 that's starting to be built right now. We will see that come to fruition in the next 5 to 10 years. These companies are going to benefit massively from it. And honestly, guys, I think a lot of these two companies are going to get bought out by the tech giants. Okay. And I'm not kidding you. They're going to start vertically integrating. Tesla is already starting to buy copper land, or I'm sorry, land to extract lithium. Okay. But they're going to start literally acquiring these companies so they can vertically integrate their entire process. Okay. So they're going to be massive beneficiaries from that. Okay, so we're going to get you some exposure there with a smaller portion of the capital. And really, guys, the number one risk for these companies is not having enough of these two materials, right? Okay. And then once again, guys, we do have our UVXY, and Angel wrote in a great question. She says, why is UVXY negative? Yeah, Angel, it's doing its job. It's supposed to be negative, guys, on up days. Okay. Unless we get a huge movement up really, really quickly, because volatility is actually connected to the velocity and the rate of change of markets, right? So volatility can actually spike up on the way up if it moves fast enough up. And we've seen days, I'm not kidding you, that the market spiked up super hard. So you see all assets fly, and this actually spikes up because the rate of change was so fast, it spikes upwards. So the vaccines were announcement rolled out. That certainly actually sent volatility up. But so great question, Angel. I'm glad you brought that up. And keep those questions coming, Angel. That was great. Everyone else in here too, please. Okay. So the UVXY, guys, that's our insurance and our volatility hedge. And so many people have a hard time understanding this. So what I'm going to do, guys, is do this in the very beginning of the presentation so you have a great example. This seems to be the number one thing that people don't understand when I talk to them. Okay. And I get it because, no one's really seen risk parity and how it works and why. Okay. So I get that, right? So everything you're seeing, guys, is new. So let's go ahead and overlay the TQQQ ETF. Okay, but let's look at it through its drop, right, coming through Q1 when we had that nasty 34% sell-off, okay, in the S&P 500. Okay, so that's the TQQQ ETF. Now, guys, let's overlay the UVXY ETF. Okay, and this is always the number one question I have that when I talk with clients. So I'm going to make sure that this is at the very front of our presentation. It's really cool, guys. I actually had a former hedge fund manager that he's in the process of setting up an LLC in Florida. He's moving from Virginia to Florida. Really cool guy named Jeff. Jeff, if you're listening out there, bud, I'm going to use you for this example. He's a former hedge fund manager. And he said he was absolutely blown away by how smart our risk parity system is. Okay, so Jeff, thank you, bud. And I'm going to use you in this example. Okay, hope you're okay with that. If not, I apologize, and I'll buy you a drink once I get to Florida to say sorry. Okay, but pretty cool here, guys. So this was pretty neat. So this asset in the UVXY, okay, this spiked up actually 1,227%. Okay, so this is the number one question I get when people call me. So I'm going to put this in the webinar now. So hopefully we can clarify that. So UVXY currently represents a 15% hedge, or let's just say this is a $100,000 portfolio actually. So you guys can really see this. Let's say that that's $15,000. Okay. Now let's just say, and not that we have this, but just for this example, let's say that the TQQQ, okay, let's say we had 85,000 in it because we were 85% net long at the time coming into this. And we weren't, guys, but just to give you the example, okay, and to show you how amazing this hedge is, okay, and it really is just stunning. A couple of people I talked to this morning too before I got on the call, guys, they said, you know, I went back and I modeled this, and you guys, you're not kidding. This thing is incredibly protectionary. So no joke, guys. So the TQQQ ETF, so it went from $11, okay, to $135 at its peak. Okay, this is during the middle of the biggest percentage sell-off time period we've seen since 1925. Okay, it was 34. It was a 30-day span, calendar day. We dropped 34% in the S&P 500. Okay, all right. So if the asset went from $11 to $135, well, I know just from doing this example a few times, that's 1,227%. But just to make this really clean and super empirical for everyone that is here, okay, I am going to just show you guys visually, lay this out on the calculator here to just make sure that there's no doubting this, no questioning this whatsoever. And once again, we're going to use math to show that this is empirical evidence. Okay, so we're taking our 135 and $11, right? So we can see that that was, you know, at times is actually under $11, but we're just going to use 11, right, for this example. Okay, so let's go ahead and divide that by $11. Okay, we're dividing 135 by 11. Oops, I didn't mean to make that big. Sorry, folks. There we go. So you're going to see, guys, that asset went up 12.27x, or 1,227 if you can do math quickly. Okay, so really, really simple, guys. So let's take that. Okay, so we have $15,000, right? Because that's how much we have in our hedge here, right, in UVXY. And this is going through the nastiest crash that we've had. Okay, percentage-wise in that time frame, we had 15 grand in it, right? So 15 grand here, 15 grand there, and you guys just saw that was 12.27% or 12.12 times acceleration up, or the same equivalent of 1,227%, right? Everyone tracking on that? And if you guys can, type into the chat box if you are. Okay, so we're just taking that $15,000, guys. Okay, and what we're going to do now is simply multiply this, okay, times 12.27, the same number we just got, or the same equivalent of 1,227%. Okay, guys, and you'll see here that asset, okay, goes from $15,000 to $184,000. Okay, oops. So I'm sorry, 184,000, and let me get my eraser there. There we go. Okay. Yeah, so we're going to go ahead and move it, guys, to $184,050. Okay. So, and just for super simple math, guys, let's just say that TQQ went to zero. It didn't, but I want to give you the worst case scenario humanly possible. Even though this wasn't mathematically possible, I know humans are emotional people for some reason. When it comes to investing, you shouldn't be, but I know a lot of the clients that we work with are. So I want to show you the best example possible. So your $100,000 that you started with, okay, so you had $100K at the start, okay, or $100,000 at the start. And going through, seriously, guys, the biggest crash percentage-wise in a month, you took this $10,000 going through a crash, okay, and you turned it into $184,000. Okay, then we're going to show you guys how to scale back that defense, take some profits. Anyone have an idea where we're going to put the fresh profits, folks, from scaling back our defense? Okay, you probably guessed it. Right here. Bingo. We get to go buy more of our long assets when we scale it back. So just wanted to provide that contextual empirical evidence. Okay. It's the number one question I get when I talk to potential clients. Once they understand it, they're like, okay, this is really neat. I'm going to go ahead and sign up. Okay. But I just wanted to give that to the example and really broadcast that to everyone that's watching this live and everyone that's on the trial watching the recorded version later on today and tonight. Okay. So Jason, just wanted to give that really quick example. It's been the number one thing I think we've failed to communicate during the examples here. So I just wanted to point that out real quick.
Cool. Great job. Cut my presentation in half. Everybody knows what we need to do now. Just kidding. Okay, I'm going to throw up a testimonial. And then we actually have two clients who have offered to come on and talk with us, Jeff Olson and Edgar. Both are really sincere people that we're privileged to work with and honored that they would come on with absolutely zero compensation and share their two stories with you guys live. So let's tell everybody, what were we doing for risk parity back last March, and who is this guy who sent you a screenshot? Now, this was during a free trial with what, 580,000 behind the trading plan?
Exactly, Jason. 584 is what he started with, folks. Okay. And it was really cool. So during his free trial, guys, he made a $97,019 $97,019.89 profit during his free trial. And my favorite part of the whole thing was this is during the worst sell-off week statistically since 1929. This was on March 16th was the day he sent me this. That was the same day. If you all remember that, the stock market went limit down at 9%. And they actually shut the market off for 15 minutes. It was the second limit down shut off that day. And our clients were just making hand over fist profits. So Ron was actually on a trial, and you guys can go to our testimonial page and see, other people bragging about making over 100,000. Okay. But this was Ron during his free trial. And that was my favorite thing. And then I think the better part of actually the story than that, Jason, is his girlfriend that had over 3 million with Goldman Sachs had just shy of $1 million worth of drawdown that same week. So Ron was bragging to her when he was taking his profits, and he actually ended up taking her on a trip to Florida. So I thought that was kind of cool and a great kind of contrast to that story.
All right. Hey, Jeff, you out there, buddy? And then we'll have Edgar come on next.
Yeah, hi, Jason.
Hey, Jeff, how's it going?
It's going just fine, thank you.
So let's tell everybody your story A to Z. Don't miss out any details, okay?
There's a few. I've heard there's a couple of people on this call that have been here a few days, so forgive my redundancy, but it's a great story. My wife's tired of hearing about it. I don't get to tell it much. It's a short chapter in my life, but it's a very impactful chapter in my life as well. It starts back in 2008, the worst time to find jobs for guys like me. I worked in engineering. I was on overhead. I'm not an engineer, but I lost my job from a private company. You couldn't hold company stock any longer if you're not an employee, so I got paid out. I had a lump sum to do something with. But what that lump sum really did was illuminate the fact that I was very far behind on my retirement. I better get something going. I enjoyed the stock market. I have a degree in finance, so it's just always been something I've been interested in. I started buying financial subscriptions, and over the next decade, 12 years, I probably touched every financial publisher out there. I spent about $25,000 for 12 years. All I did was tread water. I really got nowhere. I learned two things, really. I learned that those financial publishers don't really have your back. That's how I feel at the end of all those. The second thing I learned was, I'm a very emotional investor, and I cannot trust myself to make these stock picks, when to sell, when to buy. I follow the emotions too much. I've tried to remove it, but I just can't. So I come to March of 2020, when Ron is on his 7-day trial and he's making $100,000 at the end of the 2-week run. And I told myself tomorrow will be better. Tomorrow was never better. And I talk in percentages because it levels the playing field for everyone, but I lost 40% of my portfolio. I was going down. So I went to cash, I went dark, and I decided what to do next. I figured it had to be back in the stock market. I just needed to find something different. And I did find something different. I found a portfolio builder on YouTube. I liked it a lot, and I just started my 7-day free trial. And what got me the most was listening to Jason talk about this insurance policy for your portfolio and this excuse me, risk parity and hedging for that volatility and for when that day will come. And if anybody in 12 years at $25,000 worth of lost subscription fees would have told me about that, I wouldn't be here today. But thank goodness I am here today, because I'm much further along. But what I did was join Safe Alpha. I made modest profits there, but I learned a lot, and I got a great feel for who these guys were and where I had landed. I joined the next level up, which is the Safe Growth Pro today. And I just couldn't stop the webinars. I felt like Jason was just talking to a room full of just regular people, not a bunch of finance people. And that's what I really enjoyed. I finally decided that I'm all in. I bought boot camp for life. That's where I'm at today. I'm probably, relative to a lot of people, I'm heavy into boot camp. I've been flirting with making my money back for a couple weeks now. But as of this morning, what I have made return was 92% of what I lost last March. And I'm just ready to get that 100% back in less than a year. And I try to say, honestly, if you would have told me this anywhere else, I probably wouldn't believe it. But it's a true story. And I couldn't be more thankful for these guys and to be a part of it.
Awesome.
It's a beautiful story, Jeff. Thank you so much. Now, have we compensated you in any way, shape, or form to share your story?
No, sir, you haven't. In fact, I was so thankful. I wanted to help, and I offered Dean a couple months back just to talk to folks. If anybody had a question or just talk to somebody in the program, and that worked out okay, and it has morphed into this. So you've given me nothing.
Now, let me ask you this. Have I made you work hard to earn that? You've been doing a lot of trading?
Overall, no, not a lot of trading at all. I think it really should be measured in time, not numbers of trades, because the time spent, even when there's a trade, it's just a few keystrokes, really.
Yep.
So, measured in time, if I traded for 30 minutes in a month, that was a big month.
Well, thank you so much, as always, Jeff, for sharing that story. Edgar, are you out there? Now, Edgar's a little newer.
I'm here.
Edgar, how's it going, buddy?
Fine, yourself? How you guys are doing this morning?
Great, Edgar.
I am doing great myself. How about you?
Well, I'm very happy today looking at this portfolio here. I can tell you that.
Tell us your story, Edgar.
Okay, so first of all, good morning to everyone and the people that are already on this webinar this morning. My story, it's basically that I found you guys around November last year. I think maybe a little bit earlier than that. And I started getting your webinars, invitees. So I joined pretty much every time that I had the free week. And I joined for a while, but never really wanted to pull the trigger on joining your business or what you offer here. And back in November, I was in one of the webinars when Dean put the $1 million portfolio to work. And, I was there when he did it all. And then over the months, I've been looking at it. I've been checking it out, and I see, the progress of that portfolio and the way that it moved up, the way that it is today, the percentage that it's gained so far from November till now. And, little by little, I've been getting convinced. So finally, about 9 trading days ago, January 29 this year, I decided to go ahead and give it a try. But I put my hard earned money on the line. I did not paper trade. I just went ahead and go to one of my IRA's accounts, specifically the Roth IRA. I went ahead and sold all the stock that I had in there that I used to trade with, and I sold all the positions I had, and everything that I had at that point, which was $100,000, 9 days ago. So I put it to work on the Alpha portfolio, which is the one that you guys are going to show the folks here in this webinar today. And in 9 days, I'm happy to report to you that I'm up 12% as of right now that I'm looking at it. So it's gone from 100,000 to 112,000, and that's with the adjustment that we did the other day that I was here in the call with you guys. So it's been amazing. And what I really like the most, and that I've seen it myself working with my own eyes, is the hedging of the risk. What Jeff just talked about, when you have that protection on the downside for down days, it's huge. And I was always worried, with my 401ks and my other accounts that I have, specifically with my 401k, because that's a huge amount that I have there. And you always go to the swing, because most of the 401ks, they offer certain mutual funds, but they don't offer hedge. I don't know if you guys have always noticed that, but that's something that always kept me, awake. What happened if we have a crash, which we saw back in March, right? And then you have to go through the pain and suffering of that swing, from the high all the way down. And then luckily we had kind of like a V shape and it went back. But if not, then we would have to wait, more years in order to get that money back. And for the people that are getting close to retirement, that would have been a killer. So now that I see risk parity, the way it works and hedging your risk, I'm convinced, and I signed up with your system about 2 days ago. I'm learning the ropes right now. I'm checking all the videos that you have in there and moving most of my cash out of the bank and putting it to work into the Ameritrade. I already did that yesterday, and hopefully soon I'll be getting into the bootcamp portfolio, and then I'm moving my 401k. I'm in the process of doing that so that I can also put that money to work on the Safe Alpha portfolio that you offer as well. So for the people that are listening right now that are new, or the ones that have been listening for a while, do not be like me. I mean, I waited almost 4 months in order to pull the trigger. And when I finally decided, it's worked perfectly for me. I'm really convinced, and I'm putting my money behind your strategy. So that's basically what I wanted to share with you guys today. And it's worked so far. So good, very good so far, 12% as of right now. Thank you, guys.
Beautiful, Edgar. Now, have we compensated you in any way, shape, or form to share your story?
Not at all. Nope, not at all. I actually asked Dean and you guys to bring me on, as much as you can, because I'm here at the house and I can join these calls and tell people that, hey, do not wait. Go ahead and protect your money, because you have a lot of people out there selling you a lot of stuff. And I've, like the gentleman before me, I've bought a lot of, services, and they promise you greatness and this and that. None of that work. None of that work, because they run from you in their trades. So this actually works, because these are ETF. These are the best ETF that Jeff go ahead and study, and he knows what's going on in the market, and he pretty much it's ahead of what's going to happen, and we are protected all the time with the deflation hedge that he's showing up on the screen right now. And that's really worth the money of this whole process, being protected.
Awesome,
Couldn't have
Edgar.
said it better, Edgar. Beautiful. And Jeff, you too. You guys, between the three of you, you guys make my job easy. So thank you so much. Okay, guys. So I'm going to go ahead and give you the 10,000 foot overview. And then what we really want to do is bring you on board to talk out loud and build your portfolio, let you test drive it. Okay, that's really the big goal today. Dean, should we run that poll real quick just to get a feel for the account sizes? If there's anybody out there listening who has over $250,000, I'm not going to do the test drive on the Pro, but I will show you the difference between Safe Alpha and Pro. Okay, now if you're below $250,000 in assets, Safe Alpha is really the best bet. It's really one of our faster rocket ships, but it has an excellent defense. For those of you who do have over $250,000, we can diversify capital and get it even safer. So this is safe. Pro is super safe, and our boot camp is more aggressive. So we really have 3 levels of risk, and it typically is the richer you are, you could care less about taking on risk. You're much more interested in guarding wealth and safely growing it. And as we kind of come down to smaller and smaller accounts, you're realizing, hey, I didn't save enough money for retirement. So I need to take a little extra risk. What's a safe way and smart way to take on that risk?
Or didn't invest enough money for retirement. Really?
Yeah, really, you didn't invest enough. Yep.
Yep. And Jason, actually, the poll didn't load up. I'm gonna have to have Ryan load it into this Zoom.
Okay, no worries. Oh yeah, I forgot we opened a second Zoom account. Okay, beautiful. So let's just do a quick shout out to the live crowd. And so live we have Victor Cox. He's dedicated support. My father. Okay, we got a really small little crew here, guys. We have built quite a company with, no kidding, basically 4 people. We've brought in over 1,000 members. Okay, and let me tell you this, we don't use sales letters. We give the trade alerts out for free. People see it works, and then they want to get the trade alerts in the future. Pretty simple. Now, I do want to say that if you do end up upgrading out of the free trial, instead of listening to testimonials, the 10,000 foot overview, and getting the free trading plan, you're going to get hours of education from me 3 times a week. And I think a lot of people actually enjoy the education more than they do the profits. I don't know, that might be a stretch.
No, I'm not kidding you, Jason. That I talked to 2 clients that were doing lifetime upgrades yesterday, and they said the education is the most valuable thing of what we offer. So they just reiterated that to me yesterday.
Awesome. Yeah. So free trial is great. We're going to teach you everything you need to know. You could probably build this, look back in a decade and say, thank you very much, Portfolio Builder. But then you would miss the trade alerts and the timing and everything we do provide, which is a lot of education beyond what we're discussing today. So very good, guys. Let's go ahead and do the quick 10,000 foot overview. We're going to come back to this screen. And what we really want you to do, in fact, right now, I want everybody to look on your phone, look on your computer. You're going to see a menu bar. Okay, start clicking around on that because you need to find the little chat icon. And what we want everyone to do in this webinar, and actually if you do take a step and do this, Dean has a special bonus for you, okay? So not going to find out the bonus until after we send you your free test drive. But if you do take action today live on the webinar, we have an extremely exciting bonus for you. And all you have to do is find that chat box. And what we want you to do is post your name, email, phone number, and how much money you want to test drive. And what I'm going to do is, whether it's the minimum investment per unit, which is $1,272, or you say, you know what, I want to test drive with 25K, whatever it is, we're going to screenshot this, email it to you. You're going to have a paper trade immediately. So we screenshot the price, how many shares. So if you're a little timid, don't want to pull the trigger, you can watch. If you do want to put the pedal to the metal and test drive it, then what we're going to, then you can actually be like Edgar and actually make money during your free trial. Okay, so that's going to be your option. And again, if you do take that action step today and post in the chat box, Dean has an extremely exciting bonus for you, which you'll discover after we send you your free trial test drive trade alert. Okay, so start finding that menu bar, hit the chat button, tell us how much money you want to test drive behind the system, and we're going to let those pile up in the chat box while I do the 10,000 foot overview. Then we're going to come back and I'm going to start screenshotting these and emailing them out to you. Okay, so this calculator is automatically going to tell you exactly how many shares to buy to follow it. So let's just walk through the trading plan for a $25,000 sample account. And so you can see step one is to buy 335 shares of UVXY. Okay, this thing skyrockets when stocks go down. In fact, depending on how fast the S&P 500 is falling, this can actually go up 10 times faster. So that's really the secret, is we can't just go buy inverse ETFs to do risk parity. That'd basically be like trading flat indefinitely. If you go half long, half short, well, you're going to break even. Okay, you go 80% long, 20% short, well, you're just going to have a 20% drag on your return and have absolutely no real downside protection. So you want to actually find products that act like an insurance policy where you have to pay a small premium all the darn time, and it's never useful until that one time it is. When some freak accident happens, all of a sudden you have a small minimum payment, and then they're going to cover an unlimited amount of damages. That's the kind of insurance policy we're really interested in over here at Portfolio Builder. I'm going to tell you, UVXY is the only product that exists to deliver that. And again, it can go up around 10 times faster than stocks go down, depending on how fast they're accelerating to the downside. Now, what we don't really care about are little pullbacks. Okay, tiny little pullbacks. UVXY does go up, but that's really the least of our concerns. What we're worried about is a worldwide panic where you get the whole world freaking out and dumping stocks at the same time, creating extreme volatility in stocks and potentially long-lasting damage to your returns, to your retirement account. That's where UVXY absolutely shines and can eliminate any serious risk to our portfolio. Okay, so that's what UVXY is all about. We'll look at the chart. Dean did a good job demoing that. At 14% hedge, you are super safe. Okay, now if I thought we really had a crash immediately, I would probably double that. And all I'd have to do this is shave off a little bit of one of our offensive positions and reallocate that up top. So we actually just locked in some big gains by increasing UVXY 2 days ago. That's what Edgar was talking about. And the way it works is I just come over here, and this was our most recent trade notes. We sold 1 share of the triple Q, 1 share of Bitcoin. We added rare earth metals, and we filled up the tank on our insurance. Our insurance was getting a little light because we were making so much money from the market screaming higher that our insurance had lost a lot of value, but we don't care because we're always protected. So we added a little more insurance, and typically you get about 2 to 3 big events a year where stocks go down pretty rapidly, and that's going to be your cue to dump the insurance and buy more stocks. Okay, so I'm not going to spend a whole lot of time on that. If you get nothing else from the webinar, please. Okay, if you get nothing else from this webinar, buy some UVXY, for heaven's sakes, to protect your portfolio. Okay, next, you own some stocks. We're going to outperform your stock portfolio 20 times. Okay, no joke. I don't care what you're doing. I'm going to give you a safer basket of stocks, and I'm going to outperform your return 20 times. In fact, even if you own the same stocks in my ETF, I'm still going to outperform you 20 times. Not 2 times, not 10 times, 20 times. Okay, we're going to show you proof of that. Right now, because inflation is still super low as far as the Fed considers, and the labor force participation is pathetic, unemployment is pathetic, the government's deficits are outrageous, I'm going to explain to you that this makes us very bullish on stocks. It's the exact opposite you would think. But in fact, as soon as the labor market's fixed and the economy's rolling full steam ahead, that's actually going to be when we dramatically change our positioning on the defense, at least. But until we fix the economy, we're very bullish on stocks, and we're going to explain why. But right now we have 60%, and that goes up every day because the triple Q is a rocket ship for returns. But every so often we'll sell a triple Q and reallocate and re-up our defense. Okay, so we're going to talk about the triple Q, TQQQ. That's our single most important position. The entire portfolio is designed to protect that position. So if it was a chessboard, the triple Q is the king and UVXY is the queen. Okay, and now Bitcoin, copper, and rare earth metals are the rest of the pieces on the chessboard. Okay, so that's how we're going to actually defend even more. So let's go ahead and jump into it. In our program, we ask you to stop picking stocks, stop gambling with your money, stop pretending you're a venture capital firm, okay? And let's just get real. You're in retirement. You don't need to take a bunch of risks or reinvent the wheel. Okay, so let's just really simplify this. How about wherever the super rich are parking their cash, we're going to say that's exactly where you should park your capital and protect. Okay, so it's, yeah. Okay, so let's stop trying to pick the next Amazon. I got news for you. Amazon has billions of dollars being exclusively spent trying to figure out who the next Amazon is so they can acquire them. Okay, so you don't need to do that. Amazon will do that for you. Okay, Microsoft will do that for you. Facebook will do that for you. Okay, if you go look at all these hot niches and industries that are supposed to have this exponential growth, well, that's great. But guess what? These tech giants will buy them out and accumulate them into their equity. So you don't have to worry about that. That job is being done for you when you simply buy the biggest, baddest companies in the world that have the most advantages. Okay, so we got Jeff Bezos with Amazon, Bill Gates with Microsoft, Mark Zuckerberg with Facebook, Warren Buffett's all in on Apple. We've got Elon Musk with Tesla and SpaceX, who also created PayPal. Okay, then we got the Google buddies. So bottom line is the best companies to own are right here on the screen. Apple, Microsoft, Amazon, Facebook, Google, Tesla, NVIDIA, Comcast, PayPal. Okay, that's going to represent 10 out of 105 companies in the triple Q. Now you may own these stocks individually and you may own the NASDAQ. Once again, I'm going to show you how to increase returns 20 times. Okay, and that's going to be important because it frees up money to build your defense, to build the tank. Okay, so a lot of you guys are just all in on a handful of stocks, but you have no defense, you have no strategy. You're just long a few equities, and if the market goes down, you're really going to be feeling the pain. So let's talk about our ETF. This is the QQQ, the NASDAQ. I just want to point out really quick on the big scheme of things, look at the return from the dot-com bubble to 2008, and then compare it to the 2008 to current bubble. And which one looks like it has a bigger return? Obviously the second bubble, right? So you got to ask yourself, have the tech companies grown that much more in this decade than the last? Or is there something else going on? Because that's going to be really important for trying to predict the next decade, right? We really want to know what's causing the stock market to go up, and why did the 2009 to 2020 decade outperform the 2002 to 2008 market? And remember, Amazon lost 98% of its value in the dot-com crash. So you couldn't have bought Amazon at a cheaper price than after that crash, but yet you got a better return in the second decade. What is causing all of this? So we're going to cover that and more. But first, I got to really convince you that I can outperform your current equities portfolio, and that's going to be really easy. So let's just look at if you had bought in 2010 the NASDAQ, which is, again, it's Apple, Microsoft, Facebook, Google. They're automatically rebalancing it as companies grow or shrink in size. And if you'd invested, you're up big, okay? You turned $1,000 into $6,800. If you had bought in 2010 after the stock crash, after quantitative easing, after the government bailed out the banks with $1 trillion, you're already at new highs, okay? So a lot of people are worried about buying at new highs. After this, you won't be so worried about it because we're going to explain to you what's really making these stocks go up. So that's a great return. If you bought our ETF, which is the exact same companies, okay, there's no difference. The only difference is going to be that they're going to give you 3 times the capital. So your stock portfolio has, let's say, $1,000 in Apple or the QQQ. Our portfolio has $3,000 split into those because our ETF is going to give you a free loan. They're going to take you from $1,000 exposure to $3,000. Now, I want to show you that doesn't triple your return. That increases the return over a decade 20-fold. So instead of turning 1,000 into 6,000 with our ETF, holding the exact same companies, you turned $1,000 into $115,000. Now think about it. If you're a millionaire, you could be sitting on a fortune of $115 million. So as a millionaire, you're doing well, but can you imagine if you had 115 million? Okay, so that's the power of making one change to your equity portfolio. And again, you now own 105 companies that are automatically rebalanced. If something bad happens to any one of those companies, they're going to dump it and replace it with a better company, which is really important. That means you can sit back and do nothing. In fact, the worst thing you can do is get worried and sell your stock. The only thing you should be selling stock for is if you want to buy something in cash. Okay, so these are the companies we recommend. A few highlights about them. This is really, I'm going to really boil it down. We all know Apple's great, has wonderful products, monopolizing the phone industry. Sure, they have some competition. But there's one thing that's really important. I'm just going to keep it really simple today. Apple is buying back its own stock. And these companies are all buying back their own stock faster than any other companies in the world. Now, what does that really mean? So as they're growing their profits and revenues, the board of directors have decided that with all the excess profits, the best thing they can do is literally take all the outstanding shares that are out in the market, weak hands who are willing to sell, and they want to pull those shares out of the weak hands with company profits, and they literally want to burn them on fire so they just don't exist. So they're taking everybody who's a weak hand and needs to get out for whatever reason. They're buying those shares as a company and they're burning the shares. So the remaining shares grow their earnings per share, their cut of the pie. Okay, when you figure that out, that's the single most important thing, because this is really the only asset in the world that's on one hand growing profits and revenue, but on the other hand, reducing the number of outstanding shares. So this is one of the few assets in the world that actually has scarce, this is one of the few assets in the world that's actually becoming more scarce over time. Okay, Bitcoin has a limited quantity. It's not going to become more scarce over time. Oil, gold, silver, well, it's relatively scarce, but it's not becoming more scarce over time. The demand might be growing faster than we can find it, but it's still not shrinking. Okay, Ethereum has an unlimited quantity. Okay, you go to rare earth metals, well, they're finding that every day. Okay, so this is really the only asset in the world that on one hand is growing profits, but on the other hand is reducing outstanding shares, making them more scarce. Okay, now that's going to be important once we talk about what's fighting over those shares? Now, what's fighting over those shares is the money supply, right? That's cash. Fiat currencies are fighting over this limited and actually shrinking supply of shares of Apple, Microsoft, etc. So let's talk about what's really driving stocks up. So I'm going to tell you what we just talked about is critical, but what I'm about to show you is far more important. And the only reason why I would predict a better return in the coming decade, and how I can explain why 2008 to 2020 blew away the returns from the dot-com bubble to the housing crisis. Okay, so we're going to explain this to you. Here's the government's budget in December. We collected $346 billion in taxes, but we spent $490 billion. That's a deficit, an account deficit of $150 billion. Now, where did this money come from? Do you think that printing dollars creates wealth or productivity, efficiency? No, it sure doesn't. And if I come down here, the government has a nice handy little chart that really visually displays what's really going on with the value of the dollar. So I want to tell you these little brown boxes represent spending of about $100 to $150 billion a month that we don't have. These represent spending nearly $1 trillion we don't have. Now we throw around these names, $1 billion or $1 trillion, because we've really been brainwashed to not even think twice about it. But the reality is every month that transpires, your government is spending money it doesn't have, and it's printing the dollars to do this, which is making the value of every dollar fall as time progresses. And once you realize that the cost of the government is going to exponentially grow, and that the voter base is going to demand politicians continue these policies of spending money we don't have, wanting free stuff, and that we actually have $100 trillion. We have $100 trillion of future liabilities that we've promised voters. Okay, we're never going to be able to use real taxes to do that, and they know it. So the plan is to print money and keep everybody happy and stay in office. That's your government's plan. And it's going to get worse and worse and worse. In fact, here's an interesting way to look at it. Here's the chart of the US government's surplus or deficit. I'll make this really easy for you. If your government is running operations ineffectively and spending more money than it makes, it's going to do that by devaluing its dollar or its currency, and your country is going to devalue its bond market, which means the value of the dollar and US debt is going to fall. Okay, and they're both the same thing. A bond is just a leverage bet on the future value of the dollar. So to really simplify life for you, if you believe your government is going to go into greater debt at an exponential pace for the foreseeable future, you should anticipate an exponential gain in the stock market because the dollar is going to fall in value rapidly. Now, on the other hand, if your government is creating a surplus, and this chart we're pointing the opposite direction, you'd want to bet the exact opposite. You'd want to bet on the value of the dollar, the bond market, and be skeptical of the future value of stocks because the dollar is appreciating. So just ask yourself this: do the powers that be talk about balancing the budget? Do they talk about cutting out all the free stuff we give everyone? Do they talk about austerity? No, not really, do they? What we hear is $2 trillion is not enough to get us out of the hole after we did $1 trillion stimulus in December and a $3.5 trillion last summer. And now they want to do $5 trillion debt binge to rebuild America for climate change. And they want to do unemployment for everybody. Okay, so their plan is very clear. It's to spend loads of money that they don't have. Okay, and even if they weren't creating all these new stimulus plans, I'm going to tell you what, just to keep up with old promises, not even all this new stuff we're pushing on the world, that's $100 trillion into the future. So, spoiler alert, your government's not just going to blow out its deficit for the foreseeable future, it's going to blow it out at a faster pace. Okay, there's no getting out of it. Until they break the system itself, this is the plan. This is what voters demand. And anybody who tries to do anything else is quickly kicked out of the government and voted out of office. So once we get that, let's just talk about how this works. So you get the three branches of government to agree on a budget. It's all controlled by the Democrats. So as long as it's a partisan bill with Kamala Harris, they control the Senate. So they control all spending by one vote. Okay, now they're trying to add DC and Puerto Rico to be new states, which are heavily Democratic. So if they pull that off, they're going to be spending unlimited amounts of money for who knows how long. It could be years or decades. So we'll see how that Senate race comes across in 2 years. But for now, they have free power to spend as long as all the Democrats agree on whatever it is they want to do. So right now it's $2 trillion. Just wait another 4 months, it'll be another $1 trillion. We're going to have $5 trillion infrastructure plan. So it's piling up. The amount of money they want to spend is unbelievable. I don't even worry about that anymore. So let's talk about how this all works. Three branches approve the budget. You go to the Treasury, they issue the debt. Who buys all this debt? You think nobody would want to touch it, right? Well, actually, the primary dealers have to buy all of it, and they love it. The main primary dealer is JP Morgan. They get to go borrow from the Fed at the effective federal funds rate. So guess what? Whenever your government's going to go on a spending binge, the central bank lowers interest rates to 0. JP Morgan comes out, borrows at 0, buys up all of our debt being sold. Okay, then they go resell it to other central banks, big pension funds, broker dealers, and then they can resell it. Other countries need dollars. So rather than just have cash, they don't mind buying T-bills, which expire quickly, and they need it to operate their economy. Right now, about a third of all the debt JP Morgan is buying, nobody wants to touch. And that's where the magic really happens. So when the government's spending more money than it can afford, and the central bank knows they can't afford higher interest payments, let's go back to the interest payment. Right now, for every dollar the US government collects, 10% approximately is going to interest. So we're kind of like a medium risk credit card right now for how we operate the country. If we're not careful, pretty soon we're going to be spending maybe 20 cents on the dollar to our sugar daddies who've lent the US all this massive, ridiculous amount of money that, again, we'll never be able to repay. If you think that America is going to repay all its debt, good luck, Chuck. Not going to happen. So what we're really doing is suppressing interest rates and financing our own debt by devaluing the dollar. And so when you see a country's central bank balance sheet grow, that's really simple. It means the government is working inefficiently, it's spending more money than it makes, and it's devaluing its currency and bond market to accomplish this. And so when that happens, it's very easy to predict what's going to happen. Dollar and the bond market go down, and stocks go up. Okay, it's really two markets out there. You could really simplify the world to bonds and stocks. Okay, so if bonds are going to go down, where the hell is all the money going to go? It's not going to go to the dollar. It's not going to go to the bond market. It's all going to go to stocks and other resources that are scarce in availability. Okay, it's just that easy. So if we can predict the central bank's balance sheet, we can easily predict the future of the stock market. Okay, and spoiler alert, right now they're saying they're confident with basically a $1.5 trillion annual QE package. But we're rolling over 8 trillion of old debt, plus we're going to run a 4 trillion deficit this year, maybe more. So there's no way. They're going to have to not just do 1.5 trillion QE. I think they're going to have to go closer to 2 to 3 trillion. And when we look at how fast the labor market's recovering, it's at a snail's pace. So labor force participation is going to remain low and stagnant. Job recovery is going to be slow as grandpa getting out of bed. So bottom line is the US government's trapped. We're going to be spending more money than we make at a growing pace for decades to come. Okay, like it or not, that's the stark reality of the United States. So that's easy to predict. Government's going to blow money it doesn't have, and that's why stocks are going to go up. Now I want to point this out. If you like the last decade's returns, it cost us $1 trillion here, another $1 trillion here, another trillion by 2014, and by 2015, we'd printed $3.5 trillion. Guess what? We printed $3.5 trillion in 3 months. And now we're on pace to do $1.5 trillion a year. So I believe because of this, you'll see a better return in the coming decade than the previous decade. Now you might be saying, well, wait, the stock market went up from 2016 to 2020. And I can see they actually flatlined the balance sheet and shrunk it. So what's your thinking there? Was it just Trump was amazing and the tax cuts did the work? I'm going to tell you, maybe that was not the main thing. What if we go look at the European Central Bank? That's funny. Right when the US stopped, Europe took turns printing money at the fastest pace in their history. And now they're printing at the fastest pace as well. What about Japan? Oh, wait, they were printing from 2016 onward. What about China? Oh, actually, China nearly collapsed their housing market in 2015. So they did massive printing. Now, China's a little different. You'd have to come to a premium webinar to understand the difference, but they're printing at the fastest pace in their history now and in 2015 and 17. So what I'd like to stress is that's really the central banks expanding their balance sheet that forces stocks higher. And if we can predict those balance sheets into the future, we can easily predict the stock and bond market. Bottom line is every country worldwide is borrowing more money than they make from the lockdowns. And it's going to take at least half a decade, probably a decade, to get back to normal. So during that period, you want to be long stocks, you want to have the hedge for volatility, and we want to park more cash into protecting against inflation. Okay, with things like oil, silver, gold, rare earth metals, lithium, cobalt, graphite, copper. Okay, all the stuff we need to actually produce goods and services, those are going to go up because the value of currencies worldwide are going down. Here's a look at the dollar over a century. It's lost 98% of its value. If we look at the cost of medical care, it's up 550%. Cost of electricity is up 1,000%. Bottom line is if we were using 1980 CPI model, inflation's at 10% and rising higher. So if you have $1 million today, next year it'll be worth 900,000. You wait 5 years, it'll be worth $500,000. So that's just the reality you're living in. Now the Fed's told us the plan. They want to get their CPI model, which is totally bogus, but who cares? That's what they go by. You know, look at lumber prices. Tell me there's no inflation. Lumber is skyrocketed. It's outrageous. Look at the cost of food, rent. Okay, so they're not paying attention to real inflation. They're looking at their core inflation rate, and that just fell. So that means they're going to be worried that they need to spend even more money. Okay, listen to Janet Yellen. She says she doesn't want to make the mistakes that Bernanke did by only printing $1 trillion a year. And we need to go full-blown, massive money printing. That's all they want. That's all they talk about. Okay, and they can't get any of their core inflation data to pick up to save their lives. I don't think they're going to hit their targets. Here's what they tell you they want to do. They want to get this to 2.5 for as long as it's been below 2 and run it hot all the way to 3 before they start raising interest rates and tapering QE. Okay, and it's a big fat joke. They're not going to accomplish this because it's up to, really, it's up to government policy to create a highly efficient economy. You go print all the money in the world, you lock everybody up, scare them to death, and put lots of regulations on how they operate. Well, all you're going to do is force them to put their money in the stock market and continue to print low inflation data. So bottom line is, I anticipate this is going to take them a very long time to recover the economy, and that they're not going to hit their 2% target for a very long period of time. So we watch this every day, and most of my focus is worrying about this chart. Okay, so as soon as that gets hot, we'll tell you how to trade and make a change. But for now, you need to bet up on stocks because the government's going to kill the value of the dollar. And right now, the US dollar is starting to get too weak. The euro and the yuan are getting too strong. So what do you think Europe and China are going to do? They're going to devalue their currency because they don't want to kill their exports. So the next leg higher will probably be from other central banks printing money. Look at the bond market. It's getting crushed. That's the TLT. So here's where we park our cash. Also, we like to look at oil. Oil's telling you recovery underway. Dr. Copper predicting the same thing. Okay, so we have you long, besides the NASDAQ, we're long copper and we're long rare earth metals. Okay, all those tech giants rely on the resources mined by these companies to operate. And we're actually seeing a short squeeze coming up in this industry, which is the best way to hedge against inflation risk. So let's just put it all together. If you're putting 25,000 behind our strategy today, we're going to get 336 shares in UVXY. That's a 14% crash insurance hedge. We're going to put 138 shares in the triple Q. That outperforms any stock you can imagine, 20 to 1 over a decade. It automatically rebalances and has the biggest, baddest companies that exist. And mainly, we just care that they're buying back their stock faster than anyone else. Who cares about anything else? We're long Bitcoin. If the dollar does fall off a cliff, that's a crisis in itself. Now, if every country's in a currency war, that also makes Bitcoin go up. So we like that position, 4%. We have 118 shares of copper miners. Okay, that's used to build everything. And it's an inflation hedger. Growth stocks do not like rising interest rates or inflation because it cuts into their profits. So you definitely want to own copper miners and rare earth metals. Namely, we're getting exposure to lithium, cobalt, and all these super rare ingredients that are critical for all the high tech that's really driving the growth of tomorrow. Okay, so that's the portfolio. Time to build some screenshots out now. And let's see. So I'm going to bring everybody's microphone out so you can chat live. And let's see who's ready to get their portfolio built. Okay, so let's see. So far we have Gene wants to try a single unit. Okay, Gene, let me get you that screenshot. Okay, guys, so I'm going to start cutting out these screenshots. Let me pull up my documents. And Jean's first up to bat. So her trade alert says to pick up 17 shares of UVXY, 7 shares of the triple Q, 1 share of GBTC, 6 shares of copper miner COPX, and 1 share of rare earth metals REMX. I'm going to screenshot that and get it out to you. Who is next? And remember, if you do get your trade alert, Dean has a special bonus for you. Okay, it's only available to people who raise their hand and take that first step today. Okay, because this really shows us who's serious and who's still just kind of looking through the window. And that helps Dean focus his time and energy to people who are serious, that do want to take that first step.
Okay, great. And it looks, hey, Bob, great conversation yesterday, bud. Looks like Bob has wanted a $100,000 screenshot.
Okay, Bob's next. Gene, I need your email and phone number, okay? If you could post that in the chat box.
Will do.
Okay, great. Okay, Bob's coming in. Bob, I need your phone number for trade alerts. Mainly if we have a risk of a stock pullback, I'm going to send you an urgent alert to defend, to increase your defense. That's the main reason we want text message alerts. Okay, so Bob's coming in with a 100K portfolio. And remember, if you take that step and ask for a trade alert today, you do get a special bonus from Dean.
Yep, and awesome. Bob Bob and I had a great talk yesterday, Jason. And so cool to hear from Edgar too. Him putting to work 100,000, making 12 grand.
Right.
Okay. Very good. Okay, cool. Yeah, guys, and if you are new and you're trying to figure out the program, best way to do it is to test drive it. right? So if you didn't understand from the presentation here that the TQQQ ETF is the best performing literally ETF since its inception, and our 15% hedge will more than offset the drops in the stock market. Go back and rewatch the video again, guys. It's it's really cut and dry information. It's empirical evidence. It's math. You guys can go study it. Right? Really pretty simple to understand. Let's see here. And guys, and I'm not kidding you, I'm pretty sure that the majority of the people that have actually put in more than $50,000 during their free trial, either, made $1,000 or a couple $1,000 or made more than the cost of our service. I haven't talked to a single person actually in the last probably, I haven't talked to anyone. I can't even remember the last time, honestly, Jason, that put in $100,000 that didn't make more than the cost of our service, than all of our services, right? So just to encourage you guys, right? Look, understand that you have a massive 15% hedge to keep you safe. Okay. Angel said she has a stupid question. She said, there's no such thing as a stupid question. Number one, Angel, the more questions you have, the better. Okay, is a 14% hedge enough if everything else crashes by 40%? Yeah. And Angel, so just as we showed in the beginning, that UVX hedge went from $11 to $135. So that's a return of 1,227%. So if you're at a 14% hedge, you'd make about 70% from that hedge, even if your long assets went to zero, which they wouldn't. Okay. And I'll walk through that again to you, Angel, before the end of the presentation. But great question. And she says, okay. She says, I'm doing the calculation as we speak on Excel. Cool. And I'm asking because I still have nightmares literally from previous losses. Yeah, Angel, definitely understand that. Look, I was in my 20s, I was doing super, super risky, really dumb investments with low cap companies, right? Low cap tech stocks specifically. One of them went bankrupt that the Motley Fool recommended to millions of people, and I lost $250,000 overnight in my early 20s. So I love risk parity, guys. I will never do anything but it. And that's what we're showing here live, right? And that's why we take the time out of our day to show you guys exactly how to get this built out in the live presentation here. Okay. Okay, nice. Nice. And Bob cobbled 40 grand into portfolio yesterday and Thinkorswim. Nice. Very nice. And did you get that structured yesterday, Bob, behind the Safe Alpha portfolio as well with the 40K? And are you adding an additional 100 today? Very cool. And so Jason, the Samsung SM is Bob. Okay. Very cool. And Dave asked, during the year, do you buy and sell different ETFs? Yeah, so we'll, outside of our core positions, the COPEX, the GBTC, and the REMX, we will trade in and out of those. We had a couple trades last year. Moderna, we made over 100% on in a month. Freeport McMoran, we made like 30% in two or 3 weeks on. We do touch individual companies at times. When oil turned negative, we bought USO and we made 27% on it in 2 or 3 weeks. So yeah, we will buy and sell assets in the portfolios, guys. We should make about one change a month, basically. Okay. No, Jeff, that was actually a different Bob. And great question, Jeff. Okay. And so great question there, Dave. Champs, very nice. Okay, beautiful. Gene Delfino says, so actually the difference with your plans is playing with the different values of the ticker. No, Gene, the difference in our plans is risk, as Jason covered in the beginning, right? So we have a low risk portfolio, a medium risk portfolio, and a high risk portfolio. Okay, and the Safe Alpha that we give away on the webinar is the medium risk portfolio. Okay, and that's the one that's produced a $202,000 profit for our model portfolio here year to date, or a 20.2% return, outperforming the S&P 500 by 466%. Okay. Yep. And so we give away the Safe Alpha, guys. We don't give away our more conservative strategy that all of our millionaires use, and we don't give our most aggressive strategy that our millionaires use too, but just with the 10% of their capital or so. Okay. Very nice. Very cool. Okay. Yes. So yeah, Dave. So all trade alerts that we send our clients will go out via text message and email both. Great question. I love the text alerts, guys, because when I'm traveling, I'm busy. I'm getting probably 100 to 200 emails a day, so that kind of gets cobbled sometimes. I just use the text message alerts. 99% of the time, the text message says, no changes. Okay. And then sometimes, that will also say, critical changes to the portfolio, make these changes now. You click on the link, you can see it, and then you can literally go right to your cell phone, make the changes, and then go back to your day. Okay, beautiful. Okay, so let's see here. It looks like we had 2 people built out, which is rare. I don't know why people don't take the time to get built out here. That's the whole point of what we do, guys. And if you're scared to put money behind a really safe system, put it on a paper trading account. Okay, don't waste your time here, guys. Seriously, the worst thing you can do is take a free trial for something and not try it out. Okay, so if you want no risk, tell us, hey, Jason, I'd like a $200,000 paper allocation. So we'll send it over to you. Okay. Nice. Angel said I'll test drive on paper. Awesome, Angel. And how much would you like to do on paper? 50,000, 100,000, 500,000? What does that look like for you? And I just tell people, look, take the capital that you have in your account total, right? So if you have 300,000 in your account today, Angel, okay, or, mimic that so you can see the difference of what our portfolio does to yours. Okay. I can't tell you how many people said, I cannot believe you guys just smoked me, and I have protection, and I had protection with your account compared to my stocks where I'm long Apple and Tesla. I have absolutely no protection. You guys still outperform me. Okay. So seriously, okay, cool. And Angel wants to do 25,000. Awesome, Angel.
All right. Now Angel gets the special bonus. Remember, guys, the only way to get Dean's bonus is you have to interact with us. This is how we can separate who's serious and who's just, a window shopper. We're looking for people who actually want to put the plan to work and get results now, not tomorrow, not next week, not next year. Who's ready to get the results right now?
Yep. Who wants to do what the billionaires do as far as an investment strategy, and also have your largest position in the same position that every one of the billionaires does? So not kidding you guys. And literally, I'm not joking about that. So if you look at all of the billionaire investors, they're all using risk parity. Okay. There's none of them that don't. And look, guys, you don't have to be a billionaire to use it. You can do this with 25,000, just like Angel's doing. Okay. You can do it with 100,000 like Bob's doing. And like most of our clients that are using about $500,000 behind us, you can absolutely do it at that level and much higher. Okay.
Angel, post your phone number so that we can give you text message trade alerts too. Okay. Okay, great. So let's see, who do we still have out there? Tom, Leonard, Kurt H, IJ, Dave, and I think that's the set of people who haven't built their portfolio yet. So remember, just find that chat box. It's on the little bar, and then just type in what you want to, like Dean said, what we really want you to do is either test drive with the amount of money you're comfortable with real cash, or if you're still skeptical, tell us what your approximate account size is so I can mimic that, and then you can compare it. Does our strategy do better on down days or up days compared to your strategy? And spoiler alert, it's probably going to outperform on down days and on up days.
Yep. And definitely on the down days.
Yeah.
Okay. Awesome, Angel. And I'm sending you my number right now.
Jeff says he's made a 92% return in the last 10 months with a hedge during the period. Yep, that's beautiful, Jeff. And we haven't even really needed the hedge yet. Wait till we need the hedge. That's when everybody's really going to be thanking us, because you're going to be the only ones still standing. We got a lot of people who think they're a stock genius right now. But the second the billionaires decide to start messing with it, think about this. The billionaires could go dump 1% of their assets for fun, just for fun, and create a mini stock crash. And all the weak hands will go running for the hills, freaking out. And then what are they going to do? They're just going to cash out their insurance and melt the stock market right back up. Okay, so we're trading like the billionaires. If they decide, you know what, let's create a little sell-off for fun, which they can do with a click of a button, you're not going to have any pain. You're going to sell your UVXY for a huge gain and then buy back stocks, because there's nowhere else to put your. Think about why the stock market's going up. Because there's nowhere else you can possibly protect your money in this day and age. Okay? Governments worldwide are out of control. They're absolutely out of control. The people have given them the power to ruin the value of their money. Okay, it's atrocious, it's awful. And if you can't beat them, you better join them. Otherwise, you're going to get left behind. It's sad, but true. Okay, let's see. Okay, Angel says, I can't wait to see all these stock bulls in a bear market. Yeah. Okay, IJ says, do you use options or only stocks? Yeah, we only use ETFs. Our ETFs actually use futures and options contracts to get the leverage. So it's totally silly to ever use options again. Really, totally a waste of time. And these guys are highly sophisticated at it. So yeah, we our product does use futures and options, but because the ETFs have those built into their ETF itself. So you don't have to do anything fancy. Literally build this, sit back. You can outperform anything you've ever done with a lot less risk in multiple market environments. All right, Dean, I do need to hop off and get ready for the bootcamp webinar.
Okay, great. Very nice. Very cool. Let's see here. Dave wrote in, why participate in the expensive program when you can get similar returns with the safe program? Yeah, Dave. So our millionaires, multimillionaires, decamillionaires, they really like the safety and diversification of the pro portfolio, because it actually has 8 asset classes, right? And so sure, they can do either one. But typically our clients that have 7, 8 figures, 9 figures in the market, they like more safety. They like to diversify their their risk outside of just individual business risk. They actually like to eliminate geopolitical risk completely. They like to eliminate political risk completely and take the safest ride in the market possible. Great question, Dave. Yep. And so typically it's just our clients with 7, 8, 9 figures in the market. Okay. Bob said, can I attend the boot camp webcast? Yeah, Bob, when you get signed up, bud, you will get that access to the afternoon session. So absolutely. Of course. Okay. Great question there, Bob. Yep. And so click on that link in the email. And so, yeah, and Dave, if you want to, bud, if you want to start with the more aggressive strategy with the Absolute Alpha Bootcamp, you absolutely can do that. It's funny, a lot of our millionaires have started with that or with Safe Alpha, and then they see all the portfolios. They kind of start to realize how brilliant Jason is in risk parity, and then they get all of our programs. Okay. And then what a lot of them are honestly doing, a lot of our 7-figure clients are, they'll put 80% in the pro, 10% in Safe Alpha, 10% in the Absolute Alpha Bootcamp. That way they can just get extreme diversification, okay, and really take the safest ride possible in the market. Okay, guys, so we're going to go ahead and transition screens in just a minute here. Great question too, Dave. Very cool. And then the cool thing is too, Dave, when you pick up the Pro, you do get the Safe Alpha and the Boot Camp included. So if you buy them separate, if you buy the Safe Alpha and you buy the Boot Camp, it's $5,000, right? But if you buy the Pro, you actually get those for your first 2 years at no cost. Okay. And really, really good question. All right, guys. So we're going to go ahead and transition screens here. We're going to look at some more good data. Okay. You know what? And Dave, Jason, are you still there? Can we send Dave paper trade for 20,000?
Absolutely. Safe Alpha or Pro? Usually we only do Safe Alpha, Dave, but if you are in that larger asset class, you might want to just jump right into Pro. And it's up 20% for the year too, with twice the hedge. It's insane how well these strategies work.
You've just been on fire, Jason. Absolutely on fire.
Okay, we'll try the Safe Alpha then. Post your email and phone number, Dave, so I can get you on the trade alert list, okay?
Oh, and one Tom said he's already a member. What, Tom? What is your last name, bud? You may have had 2 emails and one was still on our marketing, so we can take you off there. But Tom, if you are a client, we'd love to hear from you. We'd love to hear what you've done so far and what you've made with us.
And Dave, please post your email and phone number so I can get this out to you, okay?
All right, there we go. Just had to get the crowd going a little bit. It just took a little time today, but we're finally getting some portfolios built here.
Yeah, I did good.
Yeah, guys, we want to put money in your pocket. That's the point of the free trial. Okay, very good. Hey, Tom, how's it going?
Good, thank you.
Oh, hey, it's Tom Sharp.
Yeah.
Nice. How have you been, Tom?
I've been pretty well. I've been a member for about a year and a half, I think, maybe something like that. And I can say that I'm very pleased with the growth so far. I don't know, I haven't calculated it because I haven't organized everything the way you have it, but I'm gradually getting there, and I'm increasing my positions from time to time, and I can endorse the program very heartily. So that's it.
Oh, awesome, Tom. Thank you so much for that.
Tom's been with us for quite a while and a lifetime member. So that's one neat thing too, guys, is once you do become comfortable, you can get a lifetime package and never pay a fee again. And Tom's been heavy on Bitcoin for quite a while, so he's been having fun with the bootcamp trade alerts. I just sent him a trade this morning, actually, huh?
Yeah.
Oh, well, thanks so much, Tom. And I'll see you in a few hours. I'm gonna go ahead and hop off, Dean.
I got a question.
Sure.
I saw something that said the webinar is usually at noon my time, which is 3 o'clock, but something said 5 o'clock. What is that changing, or?
No, it shouldn't say 5 o'clock.
3?
I'll double check. Yeah, it should be at 3 today.
And I don't
3
know
Eastern.
exactly where it was, but I saw 5 o'clock, and I just thought that was crazy. So.
No, yeah, we're off by 5, and the market's closed. I'll double check that with Ryan and see what's going on. Okay.
Okay. All right. So it is 3 o'clock.
Yeah. Normal time, 3 Eastern.
Yeah. Okay.
Cool.
Thanks. Bye.
Awesome,
Okay.
Thank you
See you in a little bit.
Yep. Thanks for that too, Tom. Thanks for your sharing your story there. Beautiful, guys. So yeah, it's Tom. He's out in the Bay Area, and he is one of our lifetime clients. So very cool. So it's neat. We get drop-ins here on our marketing webinars from our clients, and it's always super neat to see them. So awesome to see you in here, Tom. Very cool. Okay. Nice. So Dave asked, what do you think the ROI would be investing 20,000 with the 2K investment? So Tom or Dave, I think really over the year, you'll probably see somewhere between a 30 and 40% ROI. So yeah, so you can do the math there. Okay. And very cool. Yep. And then if you wanted to go for something more aggressive too, Dave, you could certainly do the Absolute Alpha Bootcamp if you're only using 20K. Okay. Beautiful. All right, guys. Awesome. And Angel, I gave you my number there. So look forward to speaking with you after the webinar. Okay, guys, let's go ahead and transition the screens here. We'll cover some more data, and we will then close out in about 15 to 20 minutes here. Okay. So real quick, we will go over to my screen here, guys, and have a little more fun before we close out for the day. Okay. So guys, it's pretty cool. We're always going to follow this rule right here when it comes to investing, right? Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. So what's in number 1 unknown risk to U.S. investors today? Cash in your account, folks. Okay. So cash is burning, sitting in your brokerage or bank account. Why? Well, as we talked about in depth, the Federal Reserve is printing money at the fastest pace in U.S. history. So you guys can leave your hard-earned money in the fire, or you can learn to invest it safely today. Okay, and it looks like about 70 of you all will be in choosing to invest it safely today. So congratulations on that. I'm glad you're taking the reins during your free trial, getting into the tank to go test drive it. Right, you're not going to be on the motorcycle without the helmet on like you are now with your count with no protection whatsoever. And also in underperforming stocks, more than likely. Okay. But we're going to show you guys really the safer way to invest. Okay. So just real quick, guys, each day you're able to reserve 1 of 3 spots available today. We don't allow more than 3 people into the portfolios. Okay. So stay tuned to see the savings you can take advantage of today. And just important note, guys, we just allow 3 spots per day per portfolio. Okay. So how can we help you and your family? Well, we have 3 portfolios you can build with us today, depending on your goals and risk tolerance. We will cover each portfolio in great detail in the following minutes. So jump in and ask questions during this process to make sure the portfolio is perfect for you. Okay. I'm going to go ahead and unmute all microphones now so you all can speak with me directly while we do this. Okay. Okay, guys. And just real quick, I'm going to go ahead and unmute everyone here. So go ahead and jump in, folks, with any questions whatsoever. Okay, so everyone is unmuted. So if you want to jump in and ask questions, please feel free to do so. Okay, and you know what? I actually haven't done this yet, but I'm going to put this on the screen. I think this will be good to utilize. So the Absolute Alpha, folks, is up 20% year-to-date return. Okay, 466% outperformance, the S&P 500. And that is, once again, YTD or year-to-date. Incredible. Okay. So every 100,000, you've already gained 20,000 in your portfolio. Every million, you've already gained 200,000. Okay, so clients with really kind of 100,000 to 500,000 love this portfolio to speed up the retirement process. Okay, it's great for investors looking to outperform the market in a safer manner. Our clients' favorite part about what we do, guys, is less drawdown. Okay, we had 80% less drawdown compared to the Dow Jones in 2020. This portfolio uses ETFs to be long or short specific asset classes. Okay, so that's really cool. Okay, you don't have to do anything complicated, no options, no chasing your tail with those options, guys. I'm going to show you the easier way to invest. And look, I've made a lot of money in options in my lifetime, guys. And after a lot, years and years and years in research on the leveraged ETFs, I have completely now stopped trading options. I still have 1 option contract. I still have 1 call option on the QQQs that's doing just incredible for me. But I'm never going to place another option trade again because options have they have a limited time value, which kills your ability to compound your money. Okay. So guys, I'm not kidding you. I've completely stopped because it's just so easy, so much less time. And for me, actually net more profitable to literally use the leveraged ETFs instead. Okay. You let their multi-million dollar infrastructure, go in and trade these options for you. Okay. You don't need to, really waste your time chasing your tail, guys, when you can simply hold, the best assets there are, let their multi-million dollar direct connections to the market, trade the options, trade hundreds of option contracts back and forth all day long. No human will ever be able to do that, guys. Just buy the ETF, let them do that all for you. Okay. And stop paying your option commissions. Okay. And hey, Bob, I see your hands up. Go ahead with the question, bud. Hey, Bob, and hey, Dave, if you guys have a question, jump in there. Anyone else too? I see your mics are open, folks. Just go ahead and jump in there. And to unmute your mics, folks, if you scroll down to kind of the bottom area of your screen, okay, in the left-hand corner, there's going to be a microphone icon. Tap that. That'll open up your mic, and then you guys can speak freely with me. Okay.
Will it be broadcast for everybody?
What's that?
Will it be broadcasted to everybody?
So this webinar?
Well, like my question, like you and I right now, does everybody hear this?
Oh yeah.
Okay.
Yeah.
All right.
Yeah, and go ahead with that question, Dave. If you want to type it into, you could certainly do that as well. Okay. Or if you want to talk one-on-one, Dave, happy to speak with you live after too, bud.
Okay, that's awesome. I just was curious because you put the ETFs, those, I think it was 5 EFTs or 6, together. But my question would be, well, first off, it's a statement. I'm involved with another program, so to speak, if you want to call it that, where they give investment advice. So I'm familiar with, paying the amount and stuff, but why wouldn't, you gave that information out. Why wouldn't just someone see that and go, okay, and then do that for the year and make money? I don't understand why you gave that information out if it's something that is like an actual portfolio versus a model portfolio.
Yeah, Dave. So our whole thing is we want to make you more money than the cost of our service during the free trial. Okay, and then if you really like what we do and the education that you got during your free trial, right? Then you upgrade, and that's been an incredibly successful business model for us. Okay, so yeah, we give away the farm. Now, Dave, what you don't get though, right, is you don't get the exclusive client webinars where we go into great detail on the assets we own and why. Future head risks that we're looking at in the markets. Okay. Also, potential assets we're looking to take some profits on existing assets and switch into them. You wouldn't see any of those changes over time, right? You wouldn't get any of the education. You wouldn't get any of the bonus trades that we put out. You don't get access to how we show you how the Fed actually controls the stock market, the bond market, the precious metals market, the value of our dollar, the first video in your boot camp modules and you'll get access on any level you sign up to those. Okay. You won't get any of that information. Also, really more than anything, the text message trade alerts that we send to our clients every time we take a profit on an asset, or if we're going to add more defense to the portfolio set, you wouldn't see any of that information. You wouldn't get our 4,680 hours a year of market monitoring. Okay. And you wouldn't get a username and password to see all of our archived information that we have stored. Okay. And great question, Dave. But yeah, so, we give out that portfolio, but we'll probably change it within a month. Okay. So you won't see those changes.
Gotcha.
Okay. And then, sometimes we make a change the next week and, who knows, Black Swan hits the market. Well, hey, we'll increase our defense side next week. If that's the case, we'll show clients how to make a lot of money doing that, protecting their money, scale it back when we're ready and go back into long side. And maybe because of that Black Swan, we switch into a different asset. Okay. And markets are dynamic, Dave. They never stop changing and evolving. Okay, so yeah, and look, we're confident that if you just set this portfolio to work, it's going to make money, right? But when we make those changes, and typically, guys, when we make changes, they're critical. Okay, so you wouldn't see any of that information, and really, you guys just see the 10,000 foot overview in this presentation, right? Start to understand why every billionaire on the planet uses risk parity. Okay, and then people typically want to understand more about that, and then see all of future changes that we have to the portfolio. Okay. So very cool. But yeah, we give it away, guys. And we actually used to give away all 3 portfolios, but we stopped doing that. We just give away the safe alpha now. Okay. And getting a little cough or echo noise from Bob there. Bob, I'm going to mute you real quick, bud. Just getting a little background noise from you there. And pretty cool, guys. So no options used, yet we're massively outperforming the market. Okay. Our outperformance to the S&P 500 on this portfolio, as you guys saw when we started up, was 466% return. Okay, so 466% is our outperformance to the S&P 500. So pretty cool, and no options. It's the beauty of using the right assets in your portfolio. Okay, and no joke, guys. My 7-year-old. It's funny. I get a lot of questions too. Well, hey Dean, is this going to be hard for me to follow? Well, my 7-year-old's doing it. And so if you can click 3 buttons or 4 buttons on your cell phone or your computer to enter a trade, if you've ever placed a stock trade or a ETF trade before, you'll absolutely be able to follow our system, guys. As long as you have capital to deploy, you have a broker, and you have the ability to do elementary school arithmetic in your head, you can absolutely follow exactly what we're doing. And no worries, Bob. And feel free to unmute too, Bob, just when you have time. Okay. And I know I did see your hand up too, Bob. So if you have a question, please feel free to ask it. Okay, bud? Very nice. So guys, the Safe Alpha trades and webinars, now only the clients, so everyone that signs up today will get this access to the Safe Alpha tomorrow if they sign up for this program. Okay, we'll meet Monday, Wednesday, and Friday at 1:30 Eastern. We're going to go into great detail on all of the big unstoppable macro trends. Okay, you guys saw the 10,000 foot overview, but if you want to really understand what's happening in the world, how the billionaires are pushing different control points into the market right now, how they're expanding new market sets and how you can take advantage of that, how to hedge against those risks too, join us Monday, Wednesday, and Friday at 1:30 with the Safe Alpha portfolio. Okay. Next, guys, is the boot camp. So I'm going to go ahead and clear off my drawings here so we can do the math here for the Absolute Alpha boot camp. Okay, when we fired up the webinar here today, guys, its return was sitting at 49% for the year. That's a 1,000% outperformance to the S&P 500. Okay, so 49%, and I'm just going to write YTD, so that stands for year to date. Right, and you can always see that in your brokerage account. Okay, and that one does have a 1,000% outperformance to the S&P 500. Okay, so our most aggressive strategy. All right, so our clients typically with under 100,000 to invest total really like this portfolio because they're behind. They haven't invested enough money over their lifetime, so they're behind. Okay. So this one, guys, is very attractive to investors that want larger risk and returns. Okay, this service has a stock and ETF portfolio engineered for massive growth. Okay, plus we'll send out other trade alerts and more exotic opportunities in this one. Okay, changes will be made on a monthly basis to ensure maximum growth. Okay, and really this has actually been a little bit quicker. And on the cryptocurrency side of this portfolio, guys, we've actually been making changes about every 3 weeks on that, just because it is growing so insanely fast. Okay, we're going to have 100+ hours of live education and training each year. You will have a sophisticated balance of core growth asset classes. Many are new to the market, and as we see new asset classes that come to the market, new ETFs and investment trusts and stuff, we will show you how to take advantage of it. Okay, options are utilized to take advantage of individual companies at times. Okay, and we don't include that in our track record, guys. They're just bonuses. Our average option return hit 68% total return last year, so pretty cool. And it's not part of the actual track record. They're just bonuses that we give out, so it's kind of cool. Okay, the Absolute Alpha members also enjoy the additional cryptocurrency portfolios that have produced a 100% return in the past month alone, and I'm not kidding you when I say that. I make too much money to sit here and waste my time. Okay, and guys, the free bonus is a 30-day access pass to the Safe Alpha portfolio. So when you sign up for the Absolute Bootcamp, folks, you will get not only the cryptocurrency portfolio, we will break that out into its own product, and it will be a $3,000 standalone product. Okay, but at this point, that is free. So this is a $3,000 product that will be broken out into its own product set. But right now, that is a free bonus. Okay. So just pretty cool, guys, when you sign up for that. So if you've never invested in cryptocurrency, definitely recommend that you use at least 3% of your total investment capital in crypto. Last time Jason did a cryptocurrency portfolio, and I'm not kidding you, it had a 1,300% return in 2017 before we told clients to take profits. Okay, so pretty cool. Okay, so we got that covered. And then the webinars are going to be Thursdays at 3 Eastern time. Okay. Any questions on that, guys?
I have a question.
Yeah, go for it, Dave.
So the crypto, and I'm looking at the market and that there's possibly others, but I mean, well, possible, I'm sure there are. Bitcoin, I mean, that's like 45,000 a share. It's like
a coin. Yeah. Yeah, we're expecting it to go closer to the 100,000 range, Dave, before the end of the year, and then before quantitative easing is over, into the 250 area.
Well, it's like kind of crazy because you watch it through the month, and it's like, like last week it was down to like 32. It's like, okay, so if someone had even just one share, they've just lost, $8,000 in like a week.
Yep. Yeah. So crypto is certainly more volatile. How we're playing it in the equity side here, okay, is with our UVXY hedge, so we can actually hedge that risk. And it's really interesting, Dave. Actually, on the biggest percentage-wise sell-off days in the overall stock market, Bitcoin's actually been rallying. So it's actually working as a hedge, actually too. So it's weird but on the really big down days in the stock market, over the past quarter, it's actually been pushing up a little bit. Okay.
So can you explain a little bit about the hedge, what you're talking? I've heard the term. I sort of know what you're talking about, but I don't really fully understand it.
Yeah, so the UVXY position, Dave, that you see in your screencast that Jason just emailed you, that's the hedge, right? So that's the volatility hedge. Okay, so yeah, that's the asset that goes up when markets are selling up. Okay, so the volatility market, folks, is a $3 trillion market. Okay, and when stocks fall really rapidly, the volatility market skyrockets upward. Okay, so that's how you saw earlier in the example, where if we just had a 15% hedge position, we had an 85% net long position, even though it went to zero. Okay, we've factored it in at zero. The hedge side, because it went up 1,227% at a $15,000 allocation, that actually turned into 184,000. So that's how you use risk parity to keep yourself safe.
So at that point, that's when. How quickly does it rise or fall? Because I mean, if you don't catch it on that day, say you're in it at $10 a share, then the market drops and that hedge goes up to $50 a share. I mean, I know you can't really predict how fast it's going to go up or how fast it's going to go down, but if you don't catch it the next day, is it then like, oh, you lost all that $50 a share, and because now it's at 25?
Yeah, no, great question, Dave. So let me actually clear off these drawings, and I'll do that same example again that we did at the beginning. Okay. So let me pull this up here. Okay. So here's the UVXY. Okay. And sorry, guys, I try to do this as cleanly as possible on our example. Okay. So this is the volatility hedge, and it doesn't just go up, in a day. It took a month to go from 11 here to 135 here. Okay. And so once again, guys, if we had the UVXY, at a 15,000, and we're just going to use a notional starting amount of 100,000. Okay, so we're just saying $100,000 account coming into this, just for simple math. I mean, our clients are using much more than this on average. Okay, with our portfolio set. I talked with the gentleman yesterday. He started with actually it was 300,000 with us second week of December, and he's now at 57,000 as of yesterday. So pretty cool. So let's just say you started with the 100,000. Okay. And today that would roughly represent an allocation to UVXY. Oops, that was a little bit of a different color of UVXY at 15% is the hedge today, or on the 100,000, obviously, $15,000. Okay, so 15,000. Okay, and coming into it, right, before the crash starts really happening, it's 11 bucks. So, hey, funny, because if we look over here, UVXY is 1044. So we'd actually be able to, you're actually able to buy it cheaper today than when the crash started forming. Okay, back in Q1. So this is a perfect example. So here's the crash, and I'm going to use green. So the purple is going to be for the defense. The green is going to be for the offense. Okay, and here's the TQQQ. So as a month, over the month, and this starts to go down before it recovers, while this over the span, folks, of 30 calendar days went up substantially. So let's just say in TQQQ here, you had 85% here long, and that's not the case, but we're just going to use that. Okay, at 85,000. And guys, in this example, I'm going to tell you that this went to zero, just so we can give you empirical evidence, okay, for the second time that this works extremely well. Okay, so zero. Okay, and also if we go over here, we're going to take this 15,000 and we multiply it times the 12.27, but let's just do the example again, since it didn't seem like that Dave caught that earlier. Okay, and Dave, thank you for the question too, but I do appreciate it. So we're taking the 135.
I simply did. Sorry.
Oh, okay, yeah, no worries, bud. Okay, cool. And then so did you see that, Dave? How we divided the 135 by the 11, right? So that's over the span of that crash. Okay, so that's a 1,227% return, or an increase of your hedge value by 12.27x.
Okay? Right. Well, I saw that example when I watched yesterday's webinar.
Okay, cool. Yeah, so you take that number of the 12.27, you multiply that times the $15,000 hedge you started with. Okay, your hedge turns into a $184,000 position. Okay, we're going to send you a trade alert that's going to tell you exactly how many shares of the UVXY you're going to sell to scale back your hedge. But net, you just made 84% from the market crashing. And in this example, guys, it was a 30, well, in the TQQQ, it crashed more. Okay, but the S&P 500 is the easiest way to kind of give the gauge of this here. Okay, and once again, we're using the example here that TQQQ goes to zero, not it goes down to at 16 bucks or whatever it did. Okay, but we're giving the example that it goes to zero, not what it went to. Okay, but
how do you predict what the bottom is?
Yeah, so it's really simple, Dave. It's going to be what the Fed does to control the market as how we're going to predict the bottom. Okay, and that's something that really no one understands, that the Fed controls the stock market, the bond market, the precious metals market, and the value of our dollar, but they can control all three, and I'll show you how to see that in just a second. Okay, so very cool. So guys, literally net, your $100,000 portfolio, if you just kept everything, okay, instead of having that huge pullback in the market, okay, you now have a portfolio going through that same exact crash scenario. If the market S&P 500 sells off 34% over 30 calendar days, just like it did, okay, in Q1, instead of having a $100,000 account, okay, going through that scenario, guys, you now have a $184,000 account. Okay. And, we're probably not going to get it that exact day that the market bottoms, but we'll probably be within a few days. Okay. And heck, even if we're within a week, guess what, guys? We're going to make 30, 40%. We're going to show you how to scale back the defense and then go buy our long assets with more money. Okay. So does that make sense to everyone? And Bob, Angel, Edgar, Gene, Kurt, Leonard, does that make sense to everyone?
It
And
makes sense. It makes sense. Will I be able to also replay this, like later today and review again? And like, will our conversation be there as well?
Yeah, absolutely, Dave. Yep. So just you can click on either the replay button, or so you can click on the text to see the replay, or you can click on the email and it'll take you to the replay as well.
Okay, because I'm watching it on my phone right now, and I can watch it later on my computer. Okay,
awesome. Yeah, and that way you'll see the visuals much better, Dave, and that'll be helpful for you for sure. Okay, great. And then Angel says, is it guaranteed that the UVXY will always go up if the market crashes? Absolutely, Angel. Yep. Volatility moves, folks, by the rate and change of the market. Okay. So there's an old saying that I learned in I think when I was a teenager. Okay. It's escalator up, elevator down. Okay. And that's how the stock market moves, right? So it moves to the upside slower and it drops much, much faster. So yeah, Angel, and you can look at volatility charts. I mean, look at a chart of the VIX over its history, overlay it with the S&P 500. Every time the S&P 500 crashes, the VIX spikes through the roof. Okay. Very cool. The VIX is the volatility index, Dave.
Oh, okay.
Yeah. Okay, cool. And Bob says, makes sense to me. Perfect, Bob. Awesome. Okay, looking good, guys. And yeah, I'm glad we did that example. It's so cool to really see how insanely powerful your insurance is here, guys. And yeah, even if we just get a little 15-20% mini crash in the stock market, hey, we'll still be able to take some profits on the defense, scale it into the long side. Okay, now and we talk about this a lot, and this is a conversation I have with clients. I don't know why there's so many people that think that there's a looming stock market crash. Okay, but guys, those people don't understand quantitative easing. But this is so cool. This is why I love my job, because I get to teach this every day. Right? So I'm going to show you guys another chart here that's going to blow your mind. Okay, and there's been 3 points in time that the Fed has made changes to absolutely change the course of the stock market. Okay, really since 2009, they made a major change in 2018, and then they also did one in it was March 23rd. I will never forget it, of 2020. It was the best buying opportunity date, single date that there is, that we've had. Okay, so does anyone know what these 3 dates are and what happened? Okay, so we see this dead nail bottom right here, dead nail bottom right here, and dead nail bottom right here. Anyone know what happened on those 3 points?
I know the first one, I lost a lot of money.
The housing bubble, right?
Yes. So good job. Good job there, Bob. Yes, this was the housing bubble. Okay, mortgage-backed securities. Thank you. That crashed the okay, that crashed the market. Okay, so good. Okay, but what happened, even more importantly than that, Bob, and great response. Okay, what happened on the first week of March of 2009? Edgar?
They bail out the banks and everybody else.
So they did. They technically started bailing out the banks before that happened, right? And they started injecting liquidity. But this date right here, guys, was QE Okay. This date right here is QE, quantitative easing. Okay. And a lot of people don't know this, but this is actually 2.0. It's not 1.0. A lot of people don't realize, they haven't studied enough, haven't gone back enough in history to realize that we actually did quantitative easing for the first time after World War II. It did more than double the U.S., the Dow Jones and the S&P 500 within a span of about 3 years. Okay. Who knows how long it took this to double the S&P 500 from QE 2.0, the exact date of they announced QE 2.0, to double the stock market. Okay. Let's see here. There you go. Angel said the printing machine went off. There you go. Yep, exactly, Angel. QE 2.0, right? Artificial liquidity is injected into the financial system, called quantitative easing. Puts in a dead nail bottom in the market, and it's reversed 500% higher since then. Okay. All right. Now, who knows this? What happened right here in this second dead nail bottom? Okay. The famous Powell pivot. Okay. So this is when Jay Powell and his buddies at the Fed that control our $120 trillion stock market, bond market, precious metals market, and value of our dollar changed their opinion. Okay. They said the economy is humming. Okay. We're going to increase interest rates to start to get back some of our debts. Market starts tanking. What do they do right here? What changes on this date, guys? Anyone know? Okay, Fed drops rates. Okay, really, really simple. Okay, so who controls our stock market, our bond market, our precious metals market, the value of our dollar? There you go, Dave. Okay, guys. Now, what is this? And look, I know Jerome Powell also tried to basically call this, it wasn't QE 3.0, but we all know what it is. And in fact, here's the other thing. Okay. Okay. And so I'm going to just put up here too, just so you guys have all these examples too. And right here, right. So this is basically when the virus hit, and I can't actually say it's words or else our videos get censored. And I'm not kidding you. On our paid side, guys, we can go a lot more in depth, and so you guys will see this. So the virus impact, right? The Powell pivot, the housing crisis, right? And how does the Fed reverse the course? They just adjust their dials, guys. That's it. Okay. So we're going to teach you more about this, how the Fed really does control our $120 trillion bond market, stock market, okay, precious metals market, value of our dollar. They control all of it. Anyone know who controls the Fed?
No.
The richest people on the planet. Okay. Who controls our governments worldwide?
Same answer, probably.
Bingo, Dave. You learn quick. Nice. Very good. Let's see here. And then Bob wrote in, he said, let's see here. You can hedge by holding half of your portfolio in cash. Black Swan hits the other 40% with the UVXY hedge for your portfolio. So you can work unscathed. Yeah. So great question or great comment on that, Bob. So you don't want to have anything in cash. And look, if we look at my portfolios, guys, look at my cash sweeping vehicle is $72, right? On my $1.3 million account, I have $72 in cash. Why? Because cash is trash. Okay. And the one thing is too, Bob, you want to always have that hedge in place so we can go scale it back and sell it, right? We can go scale that hedge back and sell it and go get more money on the long side. Okay. So yeah, cash is trash, Bob, and I would not recommend holding a cash position at all. Okay. Right. Yeah. Well, good. And Bob said, "Scared money doesn't make money." Exactly, Bob. And look, this is how you guys can literally be like our clients and not be scared money ever again, because you have your hedge, right? And you know that that is going to kick in, okay, and take place. Look, guys, volatility, the volatility market, a lot of people don't understand this too. It's expanding. Okay, it's constantly expanding. As the markets grow, as the stock market grows, as the bond market grows, so does the volatility market. Okay, it's constantly expanding. These guys make a fortune. Okay, and to your point, Angel, and I love the fact that you asked, is it guaranteed that UVXY will go up when market crashes? Angel, they make their entire living on volatility. Okay, literally, so if you look at all of the volatility companies, all the companies that create the volatility market, they made fortunes last year. Absolute fortunes. Citadel, one of the market makers for volatility, just in Q1 alone had an $8 billion quarter. And I think it was 3 times the most money that they'd ever had in a single quarter previous to it. Okay. And if you guys wonder why CBOE and companies like that bid when markets are crashing too, because they're companies creating the volatility market. Okay. Very cool. Leonard said he's at work, but I hear you guys. Awesome, Leonard. So very cool. Just so fun. Yeah, go for it, Dave. You've had great questions so far, bud.
That's fine. I just feel like I'm kind of interrupting, but
no, you're great, man.
So I know it's speculative, and your answer will be, probably a speculation. But so I've got a mutual fund that I've had one of them for over a year. But just to give an example, so last year, pretty much I had probably 45,000 in that mutual fund, and it's up and down, whatever. So this time this year, I got about 51 in there, which is good and bad, right? I mean,
sure. Which mutual fund is it?
It's a BSPAX.
Okay. Are you in Fidelity by chance, Dave?
Yes.
Okay. So what I would do, Dave, if you can, so do you have, well, first off, do you have the ability to self-direct that 401k?
I can reallocate it. Yeah, I can sell part of it, all of it, move it to something else. But before you suggest whatever you're suggesting, I just have a question on that. Can I do that?
Yeah, of course.
So if by chance last year, I would have gone, if I would have known of you guys and put that 45 in those EFTs, all those different EFTs. I mean, again, I know it's a speculative answer and I'm not naive, but I mean, what would you think it would have, because I mean, like say, to gain $5,000 in a year with $45,000, I mean, that's not horrible, but I would think there's a better vehicle that get that greater return. So what would you think with that program? I forget what it's the $2,000 or $1,900 program, what that's called. I forget.
Oh, the Safe Alpha? Yeah.
Okay.
Yeah. So great question. So the majority of the capital at this point, right, is in the TQQQ ETF. Okay. And let's just say let's say you have, and was it 51 today, Dave?
They're right around there. Yeah, it goes up and down, but it's right around there probably.
Okay. So yeah, if you switched it to being self-directed, okay, on the 51,000, okay, let's just say you liquidated the mutual fund at 51,000.
Uh-huh.
Okay. And then I'm going to look at my trade alert here for the Safe Alpha portfolio. Okay. So actually, let me go over here. And then what I'm going to do here is show you guys what the members area looks like. I'm going to switch over here from this portfolio to another one. Actually, let me see here. Okay, Safe Alpha.
So the Safe Alpha is the one where it's like a $1,900 a year.
Yeah. Uh-huh. So let's see here. So you're about at 60%, and I wanted just to confirm that. Okay, it's about 60% of your capital would be going into the TQQQ ETF. Okay, and so I'm just going to do this just quick example for you to really kind of see, Dave, what this can really do for you over 11 years. And right, this is my forward guidance. I actually think it's going to be better than what it did to achieve at a 12,000% return over the last 11 years. Okay, but just to show you for this example, what we're going to do is take this 51,000, right, and we're going to multiply it times 0.6. Okay, to understand what that percentage looks like, right? And I know that's probably pretty easy to do in our heads, but let's go ahead and get the exacts just for the example here and for the visual. Okay, so go here. So we're taking into 51,000. Okay, we multiply it times 0.6, same thing as 60%, right? We understand that David would be able to allocate about 30,600 to that. Okay. So if we take Dave's $30,600, okay, which is a good chunk, let's see what this would look like. So let's do, so we can see that this return here on the past 11 years since the inception of this ETF was, no joke, 12,660%. Okay, and I'll just highlight the 669 so you guys can understand that that is 12,000. Okay. So let's go give Dave a multiplication factor here, okay, of 12. I'm sorry, that'd be 126 times on his $300 or $30,600. Okay, Dave, that's where I think you can get in the next 11 years with the TQQQ ETF. Okay. Harder to predict shorter timelines, okay? But this is what I would expect over 11 years with that asset.
So tough to do a year thing like I was wondering.
Yeah, so broken down over time, I mean, so I just kind of roughly, I think this portfolio will produce somewhere between 30 and 40% this year. Okay, kind of nets after everything's said and done. So let's just put it in the middle at 35%. I think we'd be able to help you grow by 17,850. Or an outperformance factor what you currently have of more than 5x what you got over the last year.
Yeah, I know. It's like, like I say, seems like $5,000, quote unquote, free money is nice, but it's like, it just seems like for 50 grand or, 45, it would be, because you're based on 51, that it would be, you'd get, if you invested smarter, you'd get better returns. So,
yep. So yeah, not bad. So that's 5x what you got, right? With the mutual fund last year, or 500% better return with the Safe Alpha program.
Yeah, because I went with the mutual fund so that it would be, it's diversified. You're not really losing money. You're not gaining big money, but it's, you're keeping up at least with S&P, but.
Right. Yeah. And so this will crush the performance of the S&P. Okay. And it's going to do it safer. And the crazy thing is, Dave, a lot of the mutual funds are using bonds to hedge, and bonds do not work during quantitative easing. And in fact, last time bonds crashed almost 50% during the first 2 years of QE. Okay, and we're actually looking to potentially short the bond market. So I think the mutual funds, just like they had some pain in 2009 to 2011, they didn't really run at the same rate as the market. I think they're going to have continued underperformance moving forward here. I mean, historically they did, but yeah, I see the performance on the mutual funds, and just not something I'd be doing with my capital. That's for sure.
Yeah. Okay.
Cool.
That's a good answer. Thanks.
Yeah, my pleasure. My pleasure there, Dave. Okay,
Tell
cool.
me your name again. I'm sorry. There's a few of the names out there, so I don't know who I'm talking to.
Yeah, Dave, it's Dean Gallagher.
Dean.
And yeah.
Jason, Dean, and okay.
Yep, exactly. And then you know what, guys, I'll actually just show you guys our pictures too, just so you guys
I saw
know.
that. well.
Okay.
Yeah.
Oh, cool. Okay, good. And then so just everyone else, just real quick, let me just show you Jason and I's faces really quick. Okay. Oops. Let's see here. Whoops. Wrong side of it. Went the wrong way on the portfolio there, guys. Sorry. Give me just 1 second here, and I will get that pulled up. And I just moved my slides around the other day, guys. So give me 1 second. Okay, there we go. Yeah, so that's Jason and I. This is us on Waikiki Beach in Honolulu, Hawaii. So Jason is on the right and I'm on the left here, and that was on 4th of July. That was 2019, the day before I got married to my lovely wife.
Nice.
Yeah, so that's us. And then, guys, if you don't have my phone number yet and you want to talk after the webinar, give me a call. Okay, 505-322-7515. So I'll give you guys a second to write that down. Okay, cool. Awesome. Bob, thank you so much, bud. Look forward to talking to you this afternoon.
Do you do these webinars 3 times a week?
So we do the potential client one, Dave. I do that Monday through Friday at 11 Eastern. Okay, Jason's on for the first hour to help clients or potential clients get their portfolios built out. Okay, and really go over how the market really works, how it's controlled, really how the financial system works, because literally 100% of our potential clients never understand it. So we try our best to teach that, right? And then on the client side, Dave, the Absolute Alpha Bootcamp, it meets every Thursday at 3 Eastern. So our paid clients and everyone that gets signed up from the webinar today will be joining that group at 3 Eastern today. Okay, and let me just go back a few slides here.
So then, like tomorrow, if I jumped on this thing at the time, I would hear similar information because you have new people on every day.
Yeah, exactly, Dave. And you know, you can jump back in, ask additional questions, right? If you go back and you watch it today and you go, you know what, I didn't understand what Jason said here about the Fed or about bonds or whatever the case is. Write those questions down tonight, Dave, and bring them back tomorrow. Okay, and yeah, jump in and ask them. It's a great way to get super comfortable. And then also you can put the paper trade to work that we sent you, right? So you can see how that works. Okay, and what I would do, Dave, go and screenshot your portfolio account right now that you have with the mutual fund and its value. Okay, and then I would build out so take your 25 or I'm sorry, it was a $20,000 screenshot. What you can do is use a couple units. Okay, so do the allocation that would be about a $51,000 allocation. Okay, into the paper trading. That way you can test our Safe Alpha program against your mutual fund to see how much we smoke it over your free trial.
Because that's the 7-day free trial. Is that what it?
Yep, exactly.
To where I can do this, what I'm doing for today being day 2 for 5 more days.
Exactly. Yep. And I would definitely, Dave, just get that built with I would do a $51,000 allocation.
Yeah.
Okay. So what you can do, and just let the two portfolios, I tell people, let them race, right? Let's see how it performs. You know, it's a blast. It's the best thing you can do to test out what we do. Okay. So you can, let me go over here real quick, guys. And oops, that's the pro. Hold on 1 sec. Go to Safe Alpha. And what I'll do here is I'll send you guys this the screenshot here. Okay, so you guys can go ahead and build this out for any investment size, because you guys might say, oh, you know what? Well, gosh, I have 300,000 in my brokerage account. You know, I do want to race this against my my portfolio and see whose is working better. And really kind of get a great feel for it. So the total investment size, guys, is $1,255. So you can take that amount, okay, and simply divide it by your total investment capital to see how much to put to work, okay? So I'm just going to screenshot this here, and I'm going to just post it into the chat box for everyone, okay? So what you can do then, Dave, is take your 51,000, divide it by that unit size, okay, of 1,255 to see how many units you're going to buy. Okay, and give me 1 second, guys. I will post that into the chat box here. Okay. Okay, so that is going into the chat box now. So guys, go ahead and click on that screencast just so you have it. It's also in your email and in your text message too. But just that way, you can click on it. It'll go into your browser, and then you guys can pull up your brokerage account and literally just go build this out. Okay.
So that you can manipulate that once I get it.
No. So what you do, Dave, is you just take your 51K. Okay. So you take your 51,000. And then you simply divide it by the unit cost, okay, which is right here, right? So that's the 1,255. To understand, you're going to have X many units to build out. Okay, so let me grab my calculator here. And this is how easy it is, guys, to literally build, plug and play, and scale this thing to whatever amount of capital you want to use. Oops. So 51,000, we take that and we divide it by 1255. We understand that.
Where's that number coming from?
Yeah, so, and I know it's hard for you to see this, Dave, on your cell phone. Right here, let me.
No, I understand that, but where are you bringing it? Why are you choosing 1255?
Oh yeah, to get to an amount that's scalable without these metrics going under 1. Basically, is the easiest way to explain it. Okay. And then for us, and just for the group here, guys, we always try to keep this under 2,000. Okay, just so you can plug and play and scale literally across the entire ecosystem, right? So pretty cool. So we know that Dave could build 40 tranches, right? So, or 40 units, you can call it either one. So Dave would then go and take that screenshot. He'd multiply this 17 times 40. Okay. And don't worry about the cost, guys. The costs are irrelevant. What's critically important is that you get the number of shares. Okay. Because that, obviously the markets are dynamic. That will move. But so you take these and you multiply all these times 40. Okay. To see exactly how many shares of each asset you're going to buy.
Okay.
Yep. And then you go in.
Shares than money anyway. So.
Right. Exactly, Dave. Exactly. So then we take our calculator once again, right? And we go down the row and we'll go ahead and go 17, right? Times 40. Okay. So we'd have 680 of the defense. And so because it's defense, actually, I'm just going to draw this one in purple just because it's nice to kind of understand the two differences. So this would be 680 shares, okay, of UVXY. Bingo. So go put those into work and build your defense first, always, before you build your long side. Okay? Because we always take Warren Buffett's rule of never losing money, rule number 1, and don't forget rule number 2 into consideration with everything we will ever do for our clients and our own portfolios. Okay? So then let's go ahead and we're going to take actually, let me turn on my spotlight here just so you guys can see this better. Okay, so now we're going to go ahead and do this for the TQQQ. So now we're going to get the best performing ETF on planet Earth today. Okay, since its inception anyways, and there is one that it's beat it the last 2 years as far as total performance, and that's our core position in our bootcamp portfolio. Okay, and so you guys will see that too. Okay, so you can have 280 shares of the TQQQ asset. Okay, next we go down, right on down the line here, guys. Okay, we go to GBTC. Okay, it's 1 times 40. We all know that's 40, right? So we'll just write that out so we don't have to do the visual example. I'm sure everyone's tracking on that one. Okay, so 40 shares there because once again we took our 40 units. Okay, and we just multiplied it by the number of shares. Okay, so let's go to the next one. Okay, this is going to, so GBTC is taken care of. Let's go to COPEX. Okay, guys, COPEX is such a neat position. The Belt and Road Initiative, that will be the largest infrastructure project on planet Earth today, will require the most electric connectivity of anything that's ever been built. It's going to need a lot of copper. Okay, more than we've ever used, in factors of 100 more than we've ever used previously ever for that metal. Okay. So just one more time, guys, we will understand on COPEX, we'll be buying 240 shares, and I'm really kind of interested to see when Bill Gates and Buffett actually start either buying into these or buying these guys out. And then really too, the rare metal earth companies, you got to have these to produce anything, robotic, computer, you name it. Okay. And the same thing with the COPEX too, guys, the whole new transition to EV vehicles, right? Over time, guess what? That needs copper. Right, so the whole push to electric everything and green, guys, is going to require a ton of these positions. Copper, rare metals. Oh, Dave, go ahead, bud.
I said to say I got an EV,
Oh, nice. What'd you get?
the Tesla
Nice. Which model?
S.
Sweet. Did you get the dual motor?
Yes, definitely.
Nice. Awesome, Dave. Did you get the all-wheel drive too?
Well, that's what it is because there's a motor on each axle.
Right. Oh, yeah. Okay, cool. So yeah, it's Dave. I was so shocked when I read that technically is the fastest production vehicle that's ever been made, 0 to 60.
Yeah.
Awesome. So very cool. Jason and I have been eyeing the Cybertruck.
I know, but it's not coming out till like 22 or something.
I know it's that 500-mile range, and it's still supposed to do 0 to 60 in like 2.4 seconds or something. So
Yeah.
That's insane. But yeah, so that's what it would look like, Dave, and that's literally how easy it is to go get the whole portfolio built out for the 51, and then go race it, right? Go race it against your mutual fund and screen or write down both their amounts when you start them. Okay, and then see which one outperforms over the week. That's the best way possible, Dave, to compare apples to apples.
Unfortunately, a week is a short period of time because it could go either way. On 1 week, you got 52 of the year, so it's like. But I do understand.
Yeah, but I mean, even in that portion of time, and honestly, we're going to have such a huge advantage if there's a pullback in the market, because your mutual fund's going to get crushed, and we're not going to be nearly as harmed. Right. But then honestly, we're going to beat them to the upside too. so yeah, pick the poison, right?
Yeah, I looked at those the ETFs, all of them. They look like good ones. I mean, they've got good stocks inside them and stuff like that. So.
Right. Very nice. Awesome. Yeah. They're killer, Dave. And I mean, talk about the TQQQ, our mass position. Those are the guys that control every central bank, every government around the world, and they have a level of monopolization that's never been seen in human history before. Right. So,
and you're just diversifying is why you're not putting even more into the TQQ, right?
Right. So the number one risk, really, honestly, Dave, to the TQQQ, to the monsters in the TQQQ, not having enough of these minerals. Okay. And I'm not kidding you, Dave. You're going to start seeing rare metal earth companies get bought out by tech and copper companies too. Mark my words.
Yeah.
Oh yeah. Yeah, and because eventually they'll vertically integrate their entire business. I mean, look at Apple. They're vertically integrating to just take over the car market. They just bought 25% of Hyundai. Okay, so yeah, they're going to start, because I mean, look, their biggest expense, if you really could tear down a computer, its biggest expense is the rare earth, and the rare earth metals inside of it. Okay, so yeah. So yeah, the biggest risk to honestly that there is for these guys to continue growing is pulling more rare earth out of the ground. Okay, literally, that's the number one risk, and I'm sure you guys haven't heard that before. right? But that's seriously the number one risk that we're tracking. Okay, and these guys, as all these new initiatives are being pushed, are going to fly. I mean, absolutely fly. Record profits. You can look forward to record profits with these companies for a while to come, guys. Okay, and then
throughout the rest of the year, the next 8 months, 10 months, whatever, you're gonna see things going on in the market, and you'll send out an update to people, say, hey, sell off, or probably if something goes south, buy some more of that UVXY and sell off some of these others. Just move that particular 51 around to ward off anything or to help something, right?
Exactly. So with Bitcoin, we yesterday, or what was it yesterday? It was earlier this week. Let's see, was it Tuesday? Yeah, it was Tuesday. We hit a 100% gain on GBTC already. So we took some profits and we were able to actually buy our complete REMX position by taking profits from GBTC. And we did take one share of profit on the TQQQ as well. Okay. And then we were able to buy with house money this REMX position completely with house money. So pretty neat. And we did actually expand our positioning here in COPEX as well. Okay.
So then like that, as an example, I would have gone into Fidelity there. I would have sold off one or two shares of one of them. And then that same, minute or two later, buy a couple more shares of the other ETF.
Exactly. Yep. You got it, Dave. You learn quick, Dave. I love it.
Well, I've been trying to learn as we go along. I mean, I've been doing, I'm in a sense, I'm a slow learner because I've been looking at it, doing stuff like this for the last 5 years, trying to figure things out. I don't want to lose money, and I want to be, it's part of my retirement, and, blah, blah, blah. So.
Yeah, I hear you, Dave. Yeah. And, and I look, I'm teaching my 7-year-old risk parity. Right. And it's crazy. And there's all these products out there that teach, technicals on charts, and they teach how to find some momentum penny stock or something. Right. But there's no billionaires doing that, guys. The billionaires get the best assets on the planet and they hedge their risk. Right. That's what they do. And it's really interesting. That really no one teaches that, right? But we're here to change that. We're here to show you how to use the billionaire system, okay? And it's applicable across accounts, just like Dave's with 50K, okay? And it's also applicable, across, our clients that are using a couple $100,000, a couple $1 million. We have our first client actually that's he's basically kind of looking to either go into about an $18 million commercial real estate project or put $18 million behind our Safe Growth Pro. Okay. And so I know we have, I think it's 200 people now using 7 figures behind our either the Pro setup or a Pro with a kind of 80% in the Pro, 10% Safe Alpha, 10% Absolute Alpha Bootcamp. Okay. But pretty cool to see the level of confidence our clients are really building up to at this time. Okay. Okay, guys. So last but not least, let's cover the Safe Growth Pro for the millionaires, the multimillionaires, and the decamillionaires. Okay. Very attractive to investors with really $500,000 to $10 million to work with. Okay. Why? Because it has the greatest amount of diversification. This portfolio actually gets you into 8 different asset classes completely independent of each other. That's the whole point of what we do, guys. Get assets that are completely independent of each other. That way they counterbalance each other. Okay. So you can get the safest ride possible in the market. Okay. Very cool. So this portfolio will show you how to trade like the top hedge fund managers without the 2% management fee and 20% performance fees. News alert, every multi-billion-dollar hedge fund on planet Earth uses risk parity. Okay. Changes will be made on a weekly basis to ensure maximum protection. You'll have 150 hours of live education and Q&A with like-minded investors. Love the group that is in here. Definitely a very, very intelligent group of investors in there. Really have some pretty high level access to entrepreneurs that employ hundreds of people, VPs of publicly traded huge companies, neat group of people in there, certainly. Okay, options will be utilized at times to completely atomic bomb proof the capital. Okay, and it's just to add protection. We never use it to grow in the safe growth. Okay. And Safe Growth Pro clients enjoy paying an absolute fraction of what previously underperforming money managers, mutual funds, and hedge funds charge. Okay. And guys, this will change up, but the free bonus right now is you're going to get an annual access to the Safe Alpha and the Bootcamp portfolios for free when you do sign up. Okay. So very good, folks. And the exclusive training is Monday, Wednesday, and Friday at 3 Eastern time. Okay. So I'm going to actually skip through this, guys, because I have so many calls backed up. This is our team. Once again, Jason on the left, myself on the right, all of our team below. Okay. So if you guys have any questions, just give me a call, 505-322-7515. And if you're interested in joining, folks, type in your name and number into the chat box, and I'll give you a call after today's webinar. So yeah, and Angel said, so we'll never have a losing year. Haven't had one yet, Angel. Okay. Now, and that's the whole point, guys, keeping you safe, right? When you follow those rules and you really put Warren Buffett's number one and number two rules into your thought process, very much as Dave had kind of talked about, right? He wanted to grow his money, but he wanted to do it safely. Well, that's the beauty of risk parity, guys. That's why it's beautiful. That's why I have so much money into the market. That's why every month, I'm taking my excess, whether it's, $5,000 or 25,000, depending on the month, and put it into the market for my income streams. I'm doing it. Okay. And it goes right into the market. Why? Because I know cash is trash. It's never going to do anything for me but devalue. I know I'm going to be rewarded as an asset holder. And I know the Fed is forcing our hands to do that. I don't have control of the Fed. I'll probably never get to the level where I will have control of the Fed. So what I'm going to do, guys, is join the goals of the Fed and the same goals of the richest people on the planet. And that's to continue to leave 99% of their net worth in the stock market, continue to add money supply to the US financial system. So the net recipient of that money is, guess what, guys? Anyone take a guess? What's the net recipient of all this money being printed? Last time during quantitative easing, this time, who's the number? What do you guys think in the economy is the number one recipient of all this money that gets printed? Let's see here. Angel, you've been good. You've had some good answers. Gene, Kurt, Dave. Let's see who has the answer.
Taxes?
Nope.
No.
The stock market. How funny is that? If you guys don't think this system's rigged, I want to open your eyes a little today. Okay, so no joke. The Fed is literally printing more money. The largest companies on the planet Earth are shrinking their stock, their supply of stock, as the Fed increases the amount of money that goes to buy stock.
So I got a question.
Yeah.
So just hypothetical, say you wanted to, you're going to go buy a new car and it's going to cost you 60 grand. Would you just take out some of your assets there and do that? Or would you do it a different way?
Great question, Dave. I love when people ask that. Yeah. So my whole thing is, Dave, I won't sell my stock unless I'm going to go buy another asset, right? So unless I'm going to go buy, and exactly a car, a house. Okay. That's the only time. And I'm just going to transition the assets, right? Because I'm not going to really. So the only thing that I hold in cash too, Dave, is my SOS fund. So a customer on a call yesterday called it that, and I loved it. So I'm going to use that from now on. Okay, so my SOS funds, I keep 1 year's worth of bills, right, just in cash in my bank account, just so I have my rainy day fund for my family, my kids. Okay, but outside of that, literally everything I have goes in the U.S. equity market. okay, behind these vehicles. Okay. And it's really cool, guys, because whenever I do need to, go buy a house, and I'm looking at my portfolio, and I just see some crazy dead obvious business opportunity or something like that I'm just going to go and buy. Well, I'm going to liquidate some assets to go buy another one. But that transition time is going to be extremely minimal. And in fact, I'm not going to even sell my assets until I know that the deal is ready and I just need to pay. Right. And so that way my money is always compounding constantly. Right. And it's not just dying in the bank account. And yeah, I got to keep that money, just because, I'm extremely financially conservative. Okay. So that's why I have that, that 1 year SOS fund. Honestly, I probably don't need it. But it helps me sleep at night, right? Just like our hedges help me sleep at night too.
Okay.
Cool. Dave, phenomenal questions, bud. You get an A+ for participation today. It's great talking with you. Have fun with that car. I still have not been in a Model 3. I've been in the Model S, and it was amazing.
Yeah,
Really.
that's the one that's the S. I like it's bigger.
Oh, cool. Nice. Okay. Yeah, exactly. Sweet. Well, awesome. Well, very cool, guys. Well, hey, thank you so much for your time. Truly appreciate it. Dave, like I said, A+ for participation there, bud. Excellent questions. Anyone else have any questions before we hop off here? Okay, cool. Looking good. And Angel, great questions. Edgar, thank you so much for joining us here. Kurt, thank you very much. Give me a call, guys, if you have any questions, 505-322-7515. Have a great day, team. My pleasure. It was my pleasure to help, guys. Thank you.
Thank you.
All right. Thank you, Dave. Have a great day, bud.
You too.
Okay. Look forward to seeing who wins the race.
Yeah.